Good morning, everybody. I'm Bruce Whitfield, and it's very, very good to be with you this morning. Dan Silliman is in the background of today's events, and he's going to be talking to you from time to time. Dan, morning. Are you in control, complete control? Is everything under control, autopilot?
Well, I absolutely hope so, Bruce. Very good morning to you. Good morning to all the presenters and to the hundreds of viewers who have tuned in from South Africa and around the world. It's great to be with you again this year for BCI 2021. Yes, my name is Dan, and I'm in the background and maintaining some level of control over this event for the next 3 days. And yeah, so just a quick Zoom housekeeping. By now, you know how it works. You know where everything is. The chat feature has been disabled for the duration of the event, but you are most welcome to post your questions and comments into the Q&A box. And each of the sessions each day will be recorded. The links to the recordings will be made available to you. And it's the same link to join the Zoom today, tomorrow, and on Wednesday. So join us for all 3 days. And I think that's all from me for now. So Bruce, back over to you.
Dan, thank you very much. Dan is in charge and apparently in control. Welcome, everybody. Really good to have you with us today. All of our presenters are raring to go. You've got 14 presenters today, all the way through until lunchtime. And then, of course, there are the breakaway rooms, which we encourage you to join. And we'll give you the instructions on how to join those breakaway rooms in just a little while. First, there's going to be a South African equity focus. And who would have thought 12 months ago that South African equities would be amongst the best performing in the world over the last 12 months. This time last year, Donald Trump was president of the United States. South Africa was coming out of its hard lockdown. And we were feeling very, very bruised and quite shattered in May 2021. It was 2020, I beg your pardon. It's now May 2021. We're on the cusp of going, of course, into a third wave. We've got a very frustrating, very slow vaccine rollout in South Africa. It's happening at a glacial pace, but it is beginning to happen. So lots of uncertainties, as many uncertainties as there were this time last year. There are as many and more and different uncertainties as we go further into 2021. I'm delighted to tell you that all of your 14 presenters today have scrubbed up. Some of them have gone for haircuts. Some of them have had beard trims, and one or two have even found a tie. And remember how to tie it as well. Hopefully this is the last time that this BCI conference happens on a digital basis. I know that Tanya and the team are very, very keen to get you all back to Sphere. Yeah, so today is going to be fascinating. Fabulous insights today on a local fixed income, on global investing, lots of insights. The Q&A box is there for your questions. Can I urge you to use it at the end of each section? I'll be posing a couple of questions if there is time to our panelists. So why don't we stop gibbering and get on with today's proceedings. Up first this morning, the local equity focus, South African equity outlook and positioning. Evan Walker is with 361 Asset Management. He's going to join us first, followed by Cor Boyson at Fairtree, who runs the Select BCI Equity Fund, and then Vanessa van Vieren from Sanlam Investments, giving us a flavor of South Africa. Evan Walker, unmute and go.
Thank you, Bruce. I am unmuted and I'm ready to go. And welcome to everyone. And thank you to BCI for welcoming us back again. I forget how many years we've been represented at this conference, but it's going to be going into the 9 or 10 now. So we really appreciate the opportunity for 361 to speak and opening up this morning. Dan, you can get straight into the slides. I think given the backdrop of what we've seen in the world and the introduction from Bruce, I thought we just set a precedent, well, just set an introduction this morning for everyone else, just really what happened in the world over the last 12 months. The most phenomenal thing that did happen, despite all this COVID, was just the amount of money that was thrown by governments all around the world. I mean, this is just the US government and the amount of money that was thrown at basically the consumer to support this pandemic. And the resulting effect it had on net wealth that we saw around the world. I mean, it was an astronomical amount of money that came to the consumer, I mean, way above what they would have earned from a normal standard of living, from a normal salary point of view. And certainly a lot of that money got redirected back into markets. So this was not just a US effect, this was a global effect. And just to give you an example on slide number 2, Dan, what did that consumption actually do? So this is an actual example of what actually happened in the US. This is Target, the big US retailer, its sales growth. And you could see for last year, Target did $15 billion of additional revenue. Just to put that into context, that was equivalent to the combined 11 years growth, which they did in 1 year. And in fact, they did that in nearly 11 months. So you saw this huge amount of movement come from services-related spend, i.e. from travel and hotels and restaurants, etc., into consumption. That consumption was astronomical. It was driven by, obviously, the additional grants and income stimuluses that governments gave people around the world. And this is just one example of a retailer which benefited from this huge surge in demand for predominantly goods at the onset, obviously, food-related goods, and that then moved into more discretionary items and kitchenware, etc. And we continue to see that trend into the first quarter of this year. We've still seen Target post these unbelievable sales growth numbers up over 22% on a like-on-like basis. So huge numbers. But again, just to emphasize, 15 billions worth of sales last year, representing more than the growth that had done for the combined 11 years in the US prior to that. So who would have thought, going into a pandemic globally, that we would have such a surge in global spend on discretionary and consumer-related items? Thank you, Dan. What has also manifested itself around the world is obviously just the amount of cash that's been hoarded. I mean, this cash is just the profile of cash still sitting out there has been magnified. It's been magnified from corporates which haven't spent to consumers which haven't spent, and this is across the globe. So this is very positive still for equity markets going forward over the next 2 or 3 years, both from a capex perspective. Corporates have a huge amount of capital sitting on the sidelines. We're still expecting a huge amount of capital flow to come from the corporates. Governments are still spending a huge amount of money, and then consumers on the other side still have a lot of cash resources. So we still see a lot of pent-up demand in the system. We're still seeing that favoring equities very favorably over the next 2 years, 3 years as this begins to normalize. And we already seen a huge drive to capital expenditure, which will be quite favorable against the backdrop, and certainly against funds like ours, which are sitting with a large resource base and commodities in our mix. Thanks, Dan. So again, we've seen obviously the shift, a strong shift into demand-based sectors, away from more mobility-based sectors. I mean, this is a good indication of just those drivers. And then off the backdrop of this, now the potential of inflation fears in the market, obviously just given this unprecedented demand for products around the world. So there's parts of the US at the moment where you can't even buy a toaster. They're fully sold out. There's certain items, and we've seen lumber prices, etc., up 200%. The housing market obviously still roaring in the US, but certainly some of that will come to an end as prices just rise well above consumer expectations. Thank you, Dan. Again, that unprecedented demand for goods around the world, not just the US, parts of Europe, parts of Asia as well. Emerging markets saw the rise in freight rates. There wasn't sufficient containers to support it. What was quite phenomenal in most of these cases, and in the case of Target represented early on in the conversation, was just the fact that people were able to get the product on their shelves. So, I mean, manufacturers did respond to this, but certainly off the backdrop of getting this to market obviously came with higher freight rates, which is also a further concern for inflation over the next 12 months. Thanks, Dan. So expectations have risen. I mean, there's no doubt that for the next 2-3 quarters, inflation rates around the world will be higher. Oil prices have come roaring back. Consumer demand is pent up. There will be a move to services, which will obviously delay that, but it's going to be a little bit slower given the rollout of vaccinations. But there is concerns of inflation around the world. We still at 361 very much of the view that this inflation will be transitory. Things will return to normal. People will go back to services, as we've seen in the US. People will start eating out more. They will start traveling more. And the demand for actual goods and services will begin to roll over. Obviously, we're in this massive restocking phase currently as retailers around the world need to build inventories again. All the inventories have been depleted. So while we go through this phase, it's obviously a concern. And we've addressed that in our portfolios quite carefully as we've thought about these inflation concerns for our portfolios. But we're also very cognizant of the fact that inflation will begin to subside, possibly by this time next year, and we need to then be buying additional growth vectors in the portfolio for the years to come. Thank you, Dan. So what we saw in the US was very similar in South Africa and other emerging markets. Governments in South Africa threw a huge amount of money at the problem. We're fortunate, or not so fortunate, didn't really have the fiscal resources to do it, but we did do it. Our total fiscal relief from government was around 114 billion rand, which the consumer enjoyed. The banks gave a further relief in the total in interest rates and payment holidays of another 85 billion rand. And then we had incremental life insurance payments, unfortunately a lot of retrenchment payments, as we saw 2.5 million people in South Africa lose their jobs. We saw all this money come into market. So in excess of 200 billion rand was thrown at the consumer last year. That's once-off money that we don't think it's going to repeat again this year. So in the context of setting out a portfolio, a big thing to bear in mind for most asset managers today is just the base effect in all companies around the world. What is the base? Is the base distorted? And how do we grow off that base? And what are true earnings for the next 3 years, given these massive, unprecedented demand factors we saw last year? Thank you, Dan. So even on optimistic employment numbers, adding another 500,000 jobs a year to our forecasts, and we've done these forecasts with the help of Morgan Stanley as well, we're still coming out with quite muted growth in household consumption expenditure for the next couple of years. I mean, we've been quite optimistic on jobs growth into next year and the year after. I'm still nervous about that. I think the economy is restructured to a lower level of jobs as people have learned to work and run companies with less people. But we're still factoring in some sectors, that will come back quite fast if tourism returns and we see the vaccination come past, but that's only going to be the middle to end of next year. We start seeing that return, but even off that backdrop, we're looking at a very, very muted recovery in household spending going forward. Thank you, Dan. Just some indications of what that additional social grants did. I mean, you can see as a percentage of retail sales last year, the social grants rocketed, and retail sales as a percentage of household spending also went up significantly just as people switched consumption. So no, similar dynamics as to what we spoke about in the US, very similar dynamics unfolded in South Africa. Thank you, Dan. This is just an onshore example. I use Target in the US as an offshore example, but you can just see, in the likes of Cashbuild, which is very representative of the South African market, got a probably more skewed to the middle and lower end of the market, but it just gives you an indication. Really like-for-like sales in Cashbuild bumbling along for a number of years from sort of end of 2016, 17, 18, 19 and 20, not much activity, flattish as we took this as the South African economy really did bumble along. No real activity in the South African economy. That was represented in our stock market, but you could see with the likes and the print from government just how that like-for-like sales accelerated over the last couple of quarters. It's still accelerating, and a lot of that money is still in the system. The money does start to come to an end by the end of May this year, so we'll start to see some normalization of that base. But we've got to be very cognizant of these type of drivers in the South African environment and just the effect on the consumer, given that we're going to have a very lackluster recovery in jobs going forward. Thank you, Dan. The biggest concern to us in South Africa, and this is a concern that we're all living with on a daily basis, is just gross fixed capital formation as a percentage of GDP in South Africa. It's a very worrying trend in South Africa. We're just not really investing back in capital in South Africa. We're just making it more and more expensive for corporates to operate in the South African environment. It's a long-run worry for us. It's a long-run concern for us. We do hope that we get the likes of renewables in the electricity space coming through quite fast. We have positioned into some of the banks for that for the latter part of this year, and we do hoping we see some impetus there, but really government has been very slow on the implementation side and process side, and certainly getting statute in place to accelerate growth in a lot of our areas. And this is certainly the biggest single worry sitting in South Africa today, just the underinvestment in ports, rail, infrastructure, roads, etc., and just eroding the capital base of South Africa. So it's single-handedly the most important thing in South Africa, over and above consumption expenditure, just on the next 5-year view for South Africa going forward. Thank you, Dan. So what do we like in South Africa, and where are we invested? We still see copper outperforming GDP growth over the next 5 to 10 years. We think there's a structural element to copper from renewables. We think it's coming quite fast. We think it's going to be there for a long time. We've positioned into that. And we're still very, very positive on the outlook for Glencore, on the outlook for Anglo in its copper deposits. So we've still got a big view on copper, and that should still bode well for our terms of trade and the rand into the South African market over the next couple of years. Thank you, Dan. We're also still positive on the PGM cycle. We've seen PGMs up significantly, but we're really still not into a normalized phase of this PGM cycle. We've still seen huge undersupply on the semiconductor side, holding back car sales around the world. Car sales are still down 20-25% in a lot of regions. And that's really been not from a consumer demand perspective, but from a semiconductor perspective. So we're still holding a significant amount of PGMs in the portfolio. And we think we'll still hold those until we see some normalization of the semiconductor side and of demand side coming through. And these shares are obviously very, very cheap. Thank you, Dan. Thank you. Oh, that's fine. That just gives you a snapshot, and we'll send it out to you just on valuations for the resource shares. We still have a number of resource shares in the portfolio. We think they're a good hedge against inflation. We think the demand factors are still going to be very strong coming out most areas of the world. Government spending and initiatives out of the US to drive a lot of these growth rates and European growth rates should see demand over and above China, which has obviously still been the biggest driver, which we still find as positive. But certainly on valuation side, very attractive. Thank you, Dan. So just jumping into the SA portfolio, I know we've skipped around the world, and we try to give you a backdrop of what the world has looked like for the last 12 months. It really has been a consumption-driven world, a world that has driven huge distortions in the base effect. Those distortions will normalize. We're looking to obviously run a portfolio view where we got growth in the front end of the portfolio, but we're also hedging the portfolio for inflation over the next 2-3 quarters, but looking for growth further out. So a big position like Naspers going into COVID, we had close to 20% of Naspers in the portfolio. We cut it all the way back to 9%. And over the next 2-3 quarters, as we see inflation flares rise, as potentially growth stocks do worse, we'll start to claw that back on a transitory inflation view. We'll start to buy Naspers process back in the portfolios. We've spoken about our platinum and our Glencore positions. And then we've got the likes of reopening shares like Sasol and Bidcorp in the portfolio to see obviously demand factors coming through on a global basis. And both those positions we're upweighting as we speak. On the SA side, we're roughly at about 30% South African shares in the portfolio. There we heavily weighted towards the banks. So despite consumer demand factors being lackluster, we do think that capital that came to the consumer obviously puts the banks in a better position. And we really are hoping for growth to come out some of the corporate sectors, predominantly in the renewable side over the next 24 months, driving some demand growth, asset growth in the banking sectors. Thank you, Dan. So guys, I'm nearly done with the presentation. They're always short and sweet on these BCI conferences. We thank you for your time. We've been, top quartile performers at 361 over all the years. I've been there 9 years with Sai and the team now, and certainly we can look forward to well-positioned portfolios over the next 12 months. As I said, we've been first quartile performers over all durations now at 361, which I think it puts us in very good stead. We really have protected your capital well and driven growth in all aspects, but we really have at the same time been conscious of the portfolio view and looking out over the next 2-3 quarters, as well as looking out over 12-24 months for all aspects of growth. I mean, a share that I didn't mention, which we've done very well over the last 2 quarters, has been Distel in the portfolios. We had a big position in Distel on the South African side. That's done very well for us. So we still are looking for opportunities in the South African market. We're cognizant of the low growth environment we're in, but there's always opportunities out there, and those opportunities are always available. So if you need more detail on specifics of the portfolios, please come back into our team and we'll gladly help you. And thank you for everyone for the support, and we'll hand you back. I think I'm done with my time. Thank you, Bruce. Bruce, are you coming back?
Well, you see, the way this works now, Evan, is that it's seamless between you and Cor, and then seamless between Cor and Vanessa. Them's the rules, you see. Cor, there you are. You found a jacket. Well done. Over to you, Cor.
Thank you, Bruce. Can you guys see the presentation?
Not yet, Cor. I'll let you know when we can.
There we go.
There we go. We can see your points.
There we go.
Perfect.
Just want to highlight a couple of funds that we manage on behalf of our partner BCI. There's 7 of them. Obviously, today we're talking more about equity, so the Select BCI Equity Fund there at the top is probably the most relevant to today's discussion. I think when we talk about emerging markets, of which Africa is one, there's always 2 forces that we look at to determine whether we are in the beginning of an upswing or not. So Africa on its own doesn't really have the ability to kind of generate growth by itself. If it was the case, obviously we would have been a developed country by now. There's a lot of factors, external factors, that actually determine the economic cycles that we go into. And I think this slide kind of talks to that. So this is just a snapshot of South Africa's current account as a percentage of GDP. And you can see it hasn't been since the 80s that we've had such a strong current account percentage as a percentage of the GDP. Now, this is quite important for us because it gives us a good sense of the size of the external tailwinds that we are busy experiencing. So when a current account is this positive, it means there's a lot of the value of the imports the value of the exports exceeds imports by quite a bit. It's good for our rand. So rand appreciates, and we've seen that over the last number of months. And it's also good for inflation locally. So it helps the central banks or the Reserve Bank not to increase interest rates, and that helps the consumer to spend. So as you can see from here, we're quite pleased to see such a strong GDP current account ratio, and we think this is actually here to stay for a while. Now, just to dive into a little bit of detail as to, so this is a very macro slide, but I mean, sometimes we forget to also look at the detail that builds up into this slide. The next slide to us is actually giving some more color as to how powerful the external factors are at the moment. On the left, what you have there is Impala's EBITDA. That's a good indication for cash flow. You can see historically over the last 20 years, the orange bars there, the bottom there, that's the EBITDA that's been generated. You can see the boom times there that we had during the super cycle, where it went from 4 billion in 2004 to 17 billion rand in 2008. We've just had an unbelievable year. These are financial years, so this is up until that 28 there for 2020. That's until June 2020. We've had an unbelievable run in profitability for these shares. I mean, we were thinking that a share like Impala was going to go bankrupt in 2017. And we are 1 month away from the 2021 number. And by our estimates, that number is going to almost triple to 76 billion. And if spot remains, it's going to go up to 100 billion rand. Now, these numbers are eye-watering. Pleasingly for us, it is not being priced in by the market. If you run spot, free cash flow yields of 32%, Ps of 3.3, EBITDA of 1.4. Now, this is not only important for picking shares. The secondary effect of this is extremely positive for our country, And I think not a lot of people are talking about this because we tend to always focus on the negative side. If you look on the right-hand side there, that's the value-added statement for Impala. And we've broken it up into quite a couple of important components. One, labor, the orange there at the bottom, you can see although it's not increasing by a lot, but labor is going to increase in terms of what people are getting from employment through bonuses, etc. Very importantly, if you look at the blue line there, or the blue bar, that is taxes and royalties. Now, we were all worried last year that we're going to have a sovereign debt crisis. Where's the taxes going to come from? We have very slow GDP growth. Lots of people are losing their jobs. External factors in this case is actually increasing just from the mining sector. And I'm just using Impala here as an example. Most of the mining companies are in this position. It's going from 4 billion Rand in 2019. It's more than doubled in 2020 to 10. And it's at current run rate is going to be 23 billion Rand. This is going to help a lot in terms of our local economy, especially for the government, for SARS. And obviously important for us is the grey there. That's the excess value that goes to the holders of the shareholders of this company. So obviously, from an SA Inc. point of view, this is an important slide because this actually gives you some color as to the extent of the power that the external tailwinds is busy expressing onto the local economy. Now, from an internal point of view, we're all quite impatient because we want to see corruption being dealt with. We want to see us fixing ourselves. This is happening extremely slowly, and we're all frustrated. But this is not the only this is not the only thing that's going to help us. We've seen the immense power of the external forces currently on our economy. But slowly but surely, we are busy rebuilding our institutions. Over the last 10 years, there's been a slow deterioration of our institutions by the previous government. And I think very few people can actually make a case that we are not moving in the right direction, albeit slow. The Hawks has made a number of arrests, most recently the arrest of Ace Magashule. He's going to stand trial soon. And we think more risks is forthcoming. The NPA, since Sean Abrams has been fired, has rebuilt that institution, and most recently 4 very important heads have been appointed to improve the ability for the NPA to prosecute, to root out corruption, which is a cancer in our society. SARS has been stabilized since the appointment of Edward Kieswetter. Things have stabilized there, and most recently revenues have been 138 billion Rand higher than what we forecasted. And then from an Eskom point of view, I think we all know how serious the problem there is. Andre de Ruyter, since he's been appointed, he hasn't been able to avoid load shedding. I think the problem is bigger for one man to be able to go there and just change it around single-handedly. But slowly but surely, we are getting stable feedback from there. We know when there's a plan. We know there's light at the end of the tunnel. And importantly, they're well on their way to divisionalize the Eskom and break it up in parts. And that's going to assist the private sector to eventually address the growth impediments that we've got in this country. So although it's slow, the internal drivers are heading in the right direction. I think the one thing that we want to see is growth. And we've experienced a number of years of very mundane growth. If you look at the blue line there, that's SA GDP growth. We had very good years prior to 2008 due to the super cycle. Again, the super cycle wasn't Thabo Mbeki. It was China that's driven that. And you can see how high the growth was during that period. We've seen a slow deterioration over time. The forecast in last year for this year was 1.9 growth in this year, and then it was upgraded to 2.5, and I think it's now closer to 3.5. we are of the view that the growth is going to surprise people on the upside. If you look at the orange line there, that's a leading business cycle indicator. It is the highest it's been for the last 16 years. And I think a lot of people are just dismissing this as just base effects. But we think, given what we see from external factors, even some of the internal progress that's been made, that we could see a higher GDP growth than what people are expecting on the street. Now, why is this good for South Africa? It's good because there's growth, but importantly, where are we starting off from in looking at the local market? This is the simple valuation metric. It's the price to book valuation for the retailers in the bank. The next slide is for industrial companies and the telcos. And you can see we were already cheap at the beginning of last year, and but we couldn't see significant growth drivers. We've had a leg down during the pandemic, during the lockdowns, and as Bruce have mentioned, we've had the best 12 months in the globe. But that's just a little rise there at the bottom there from average levels of 2 for banks and retailers at 5.1. If GDP growth comes back, now valuations correlates with growth. So the higher the growth, the higher the valuation. So the low valuations that we've seen over the last number of years was representative of low growth. If we can get growth back, we can have this wonderful combination of very low starting valuations combined with growth, which will not only increase profits, but also the price people are willing, the valuation people are willing to pay for these sectors. So this is the banks and the retailers. And the next slide just tells you it's the SA Inc., SA Industrials. There's 15 companies in that index that we've created, and then obviously the 3 telcos. The story is consistent in that South Africa Inc. is extremely cheap at the moment. The starting point is extremely cheap, and if we can get growth back on a sustainable basis, we are at the beginning of 3 to 5, even 10 years, depending on how the future plays out, of extremely strong returns in the local market. I don't want to highlight specific shares. It's difficult to highlight specific shares because they're all cheap. And therefore, I think if you just, we like the resources, we like the SA Inc. part of the market. Now this concludes my end of the presentation. Thanks, Bruce.
The seamless thing needs work, Vanessa. The seamlessness thing needs work. But there you are being seamless. Carry on.
Okay, I can't share screen until core. You need to stop sharing. Cool. Thanks. Okay, can you guys all see that? Okay, great. So my discussion today is basically looking at zooming in a little bit on the more micro side of the impacts of COVID-19 on particularly the small and mid-cap equities. My prior two speakers have actually set me up quite nicely for my discussion, so hopefully it'll flow quite nicely for you guys. I just wanted to start with one of my favorite quotes in the market. You know, the famous Black Swan author Nassim Taleb said that to not foresee a tsunami or a crash is forgivable, but to build something fragile is not. And I think this is a very poignant and perfect description for what's actually hit us, because effectively, you know, we've had this unprecedented experience of COVID, but to see how we've come out of that is effectively dependent on whether or not we had something fragile in place or not, and something robust. So I think that just sets the scene nicely. If we just take a look at the pre-COVID-19 backdrop, I mean, what I've tried to highlight here, and I think I've spoken to this audience in the past many times, just about, and to some degree the previous speakers addressed it, just the very, very weak backdrop we've had for small and medium-sized companies in this country. I mean, it's been a low growth situation, and the guys have shown GDP graphs, and perhaps my graph on the left just highlights that perhaps if you look in the last 5 years, we've basically had no real growth in this country. So very tough backdrop from a macro point of view for South African small and mid-cap shares. And at the same time, if you just turn to the right, what we did here is we cut the performance off at the end of 2019, 31st of December 2019, and we just show that South Africa was actually in US dollars the worst performing small cap market in the world over the previous 15 years. So, and this led to some of the commentators out there who are particularly experts in the space saying that we had the cheapest small caps in the world. And so the idea that I want to give you guys is that going into COVID, we were already in a difficult and marginal position. Then COVID came, and I'm calling that the black swan, even though Mr. Taleb doesn't like to say that the pandemic is a black swan. The reality is, for us, it was an unprecedented experience in the market. And what we saw was huge volatility last year. And initially, with the first drawdown from the end of December 2019 to the bottom of the market around the 23rd of March last year, the SWIX fell over 30%, and you can just see how mid and smalls compared to that. So underperforming, just falling very dramatically. Very similar drawdown to what you saw in the GFC in South Africa. At the same time, the economy, we saw an unprecedented contraction in the economy over 100 years. We saw real GDP falling by 7%. And initially, the forecast by many market players was, 8 to 9% type drop, and we ended up down 7%, but still this extremely dramatic in terms of the impact. And then if you look at it from a sector point of view, we know that there were many sectors that were affected in different ways, but many of the big sectors, like for example, hospitality and leisure, were unbelievably hit. So if you look at this is just hotel occupancies and bar and restaurant sales collapsed overnight in a very stringent lockdown 5 scenario. And even though we've had some recovery, we're not nowhere near the previous levels. So sectors like this still languishing. And then we saw, in the bank's earnings, we saw the average fall in earnings for the banks in South Africa down just under 60%. And many of the bank CEOs saying things like, this is the worst in 100 years. So just to paint how traumatic this was for us last year from an investment point of view. If you just drill into the small and mid-cap universe, what we've talked about in the past, again in this forum, is this notion of a small cap premium through time that is justified. And what we looked at was the rolling 10-year premium or discount of the performance of small and mid-caps in relation to top 40 shares. And the average through time is that they have outperformed, but if you just take the rolling 10-year period from around 2016 onwards, we went into negative territory, and small and mid-cap started to progressively underperform more and more and more as the domestic ink and the macroeconomic environment deteriorated. And we've highlighted this in past discussions here. We saw that this actually got a lot worse. So leading up to, we've cut this chart off at the very bottom of the market. So post that drop 23rd of March, and you can just see that got to sort of fairly unprecedented levels of around 3% underperformance for small caps relative to top 40 over a rolling 10-year period. So just to give you guys a sense of how bad it actually got. I'm going to change tact a little bit here and just switch to my favorite topic, which is behavioral finance. And the very famous writer and behavioral finance psychologist, Daniel Kahneman, wrote the book Thinking Fast and Slow. And he asks his readers and his audience, to look at this line and say, which line is longer? And I think naturally your initial response, you will say, well, obviously the bottom line looks longer, right? It's an automatic response, there's little to no effort, and there's no sense of voluntary control. But if you actually take rulers and you put it next to the lines, you can see that actually the lines are equal. And he refers to this as a system 2 way of thinking, which requires more effort and complex computations and a sense of agency and choice and concentration. So the idea is that in system 1, it's very fast, and system 2 is a lot more slow and deliberate. And the reason why I've set this is, as an analogy, is for how we responded to the pandemic and the impact it had on our process particularly. And I think the system 1 response out there was to immediately call out that this time it is completely different, and to panic and to say we're going to sell and that things are never going to go back to normal. And I can honestly say to you guys, none of us in this audience have experienced what we experienced last year in this global pandemic environment. So it is very easy to fall into that way of thinking. I want to then juxtapose that to how we then responded to this. And I think the important thing was that immediately in investments, we grounded ourselves in the fact that we've seen these very volatile events in the past, things like the tech bubble, things like the global financial crisis, where, again, the importance of your team being together, working together through decades of these experiences, having your intellectual property and your experience in place, and your tools in place to then deal with this type of event. And last year, Hendrik de Tooy last week, Hendrik de Tooy was doing his results presentation, and he said a fantastic and interesting thing. He said, our world in investments is one where this time it's different, seldom applies, but we constantly have to deal with change. So I thought that very beautifully described the environment. And the reality is that our research process just became the most crucial aspect to what we do. We had to interrogate, recalibrate our scenarios of the businesses that we analyze and invest in, and understand and unpack what was structural versus cyclical damage as a response to COVID. And we also then had to, where we saw very high risk in particular businesses and industries, I've given you, for example, the hospitality industry, we had to apply additional risk management and look at very extreme bear cases and erosions of permanent value out of these businesses, and then look at valuations and see whether or not they were still investable. But the reality is we grounded our process in a through the cycle valuation discipline when we could see market fear was completely pervasive around us. So that enormous drawdown that you saw. So just to highlight a couple of examples, and my prior speakers have actually helped me quite a bit. I mean, Core used, I think Core or Evan used Cashbuild as an example. I think it was Evan, yes, Cashbuild. It was just one of those examples of, I've picked up 3 small cap companies, one a tech company, Adapt IT, Cashbuild, a building retailer, and Impact, a manufacturer of paper. Just to give you 3 examples of where we were actually, given the robustness of our research process, able to pull the trigger when the time came. So when we had these extreme dislocations in the market, we were able to run our scenarios, which we've also talked about in the past in these forums in terms of our research process, which is critical. And you got to these points in some of these shares, which were just unbelievable. So you could buy a share, for example, like Adapt IT, it hits a low of R1.20. It was on virtually a 1 PE ratio versus our assessment of a bear case value. Cashbuild, we could buy a high quality small cap below its bear case value. And Monty Packaging, again, a medium quality small cap materially below our bear case value. And our bear case values were stressed to a very negative scenario. I've thrown in Sasol just out of interest because it was very topical last year, even though it's a large cap. I mean, you had the opportunity, Sasol went as low, the blue line, as 27 Rand a share, where you couldn't, pay somebody to take your barrel of oil. And since then, you've seen it just under 8 times move up of the share price. So the point is there were huge dislocations last year that gave us fantastic price opportunities. And you, having had the process in place and the research done, you could pull the trigger and actually generate some fantastic returns. The other way to look at this is how did the fundamental experience evolve for the companies in our universe? And we did a fairly crude analysis here, but we wanted to look at the mid-small universe and what was the delta in earnings, the change in earnings between the 2020 and the 2019 financial years, just looking at summing up the earnings within each sector. And the results were fairly intuitive. So we saw financials dropping by 105, industrials 54, real estate, we knew it was a bloodbath. And interestingly, the guys before have talked about the robustness in resources, which has been very disconnected from the broader economic cycle. It's actually saw earnings growth. So obviously this is interpolated for period end. So this is the rolling periods that we've taken into account. We then compared this to our portfolio and we said, well, we tell our clients that we offer them quality and risk management, essentially, and that we're going to insulate the holdings within our portfolio from the broader environment, be it a normal tough environment or something like a global pandemic, which hit us actually last year. And what we found was actually the results corroborated that. So we found that our financials actually down 41% versus that. Our resources actually performed exceptionally well. There's a little bit of an unfair comparison here in the sense that two of the shares that we held, Impala and Sibanye, I think Core spoke about Impala earlier, have obviously moved into top 40. So to some degree, there's a little bit of survivorship bias in this universe that was taken out of mid-cap into top 40 because of its outperformance, but we were able to still hold it in the portfolio. So again, just showing you that we lived by what we promised to give our clients. And then I think this slide is particularly pleasing to me. In the past, I've stood up in front of this audience and I've talked about there's a huge value in small and mid caps. And I think at some point you guys wanted to throw something at me because it was just going down and down and down. And I showed you the underperformance relative to top 40. But yet we have had a huge rebound in small caps over the last 12 months. So this is just from the market bottom. And this is comparing various small cap indices globally in US dollars. So obviously the strength of the Rand has aided the South African market return, but you can see that we've had the best performing small cap market in the world effectively for the last 12 months. And this flies in the face of many of the critics out there who said, small caps and SA Inc. are dead, take all your money offshore, that narrative of, just thinking quickly and saying, well, the environment is dead. But I wanted to put it in context. And I think some of the guys previously also spoke about this, that actually that little move up is actually a small blip in the long-term track record. So this is just going back to that initial chart I showed you where we cut it off at the end of December 2019 and we were the worst performing small cap market in the world. At that point, this is our rebound, but effectively we're still the second worst performing market in the world in US dollars, the worst being actually Japan, which you can understand, but it just shows you that we've got a lot of work to do still. And if you look at the rolling 10-year premium over top 40, we bottomed out at around 4%. It got a lot worse, and there has been a rebound because we've seen small and mid caps outperforming top 40 and SWIX over the last year, but there's still a rolling 10-year underperformance that has to be chipped away. So there's a lot of work that still needs to be done. And what I want to explain to you guys is, even though we've had that nice leg up, there's still a lot of value in our area of the market. The next slide I wanted to do was just give you guys a prognosis for our area, the small mid-cap space, and I did it in the form of a SWOT analysis. So maybe let's just start on the dark side, the negative side. And I mean, I think the weaknesses are fairly well known and documented out there, that we have a risk around protracted weak macroeconomic backdrop going forward. So yes, we're going to get a mathematical rebound this year, but the tools that are in place to give us higher level of growth that we need for small and mid caps to outperform are very precarious. So like Evan spoke about the lack of investment in the economy, it's a huge problem. So your investor capital base is weak and your infrastructure is weak, so that puts you on the back foot. And that then links to your threats, where, we have these very high structural challenges in South Africa. So, we're the most unequal society in the world. We have huge factional battles in our ruling party, which can lead to civil unrest, rampant corruption. We've seen the horror stories coming out of Zondo, and high unemployment. And maybe I just want to pause for a second there and talk about the consumer, because I think the guys have also touched on it earlier. We had structurally high unemployment going into COVID. We've lost another 2.5 million jobs, and we've had the impact of government stimulus. Now, fast forward, that's going to stop, as well as an austerity budget being put in place with civil servants, which is essential for the ratings agencies to keep us on track and not downgraded. We were lucky to not be downgraded this last weekend. It kept us on the same level. But the reality is, going forward, the runway is challenging because the consumer is going to be under huge pressure, and that government stimulus will go away. So I think that is very important to keep in the back of your mind. And we're very aware of those risks when we look at the underlying companies we invest in. Just turning to the strengths, I think our companies have got very strong balance sheets. And this is an interesting point, because I think what happened was, Evan also showed the buildup of cash in businesses, a theme we've seen across the world, where companies have sat on their cash, not invested, built up cash balances, and that puts them in a very strong position going forward for additional investment now at this point as the environment stabilizes. And I think, just a more subtle qualitative point is just the unprecedented learnings you've seen in the market. So I think our management teams have actually learned so much out of this environment, and they've been actually proven to be quite resilient. I mean, you've seen businesses like gaming, like the likes of, Sun International, Sun, shut down for multiple months with massive fixed cost bases, having to adjust themselves, cut their costs, and now resume trading and actually performing much better than expectations. So I think that's very important to note, is the learnings out of that. And then the opportunities. I mean, we know that there's going to be just a mathematical base effect rebound in 2021, both from an earnings point of view as well as an economic growth point of view. Anything in the region of 3 to 5% is being discussed out there from a 2021 calendar year of economic growth perspective, real GDP growth. But despite that, we're still seeing continued material price dislocations and value on our side of the market. I think Core showed also some of the value in the mid and the large side. That's very much a theme still on our side. Yes, we've had a run, but there is still a lot of value in the underlying opportunities in our space. So my last slide here is a little bit of a brag slide. I mean, I think we've had a really strong year in our fund. In our small cap fund, we were up 70% last year over a rolling 12-month period to the 31st of March. These bars are the alpha that we delivered for our clients relative to the underlying universe. So the orange is the 20% outperformance of the mid-small space. The mid-small space being affected by, in some degree, the mid-caps have lagged the small caps. Small caps have shot the lights out. Mid-caps have lagged a little bit, partly due to the high composition of property in their space. And then also a lot of those resources that were in there that outperformed moved into top 40. So again, hurting that side, that index in relation to small caps. But on a blended basis, mid-small gave you about 50% over the last 12 months, and we did 70. And obviously you can see, we've shown you guys before in the past what we believe is baked into our fund from an upside to intrinsic value perspective, taking each of our capital allocated to our positions. And obviously with the performance we've enjoyed, some of that embedded return has come down, but we always manage to try and keep it up. And we still feel that there is significant upside in our area, in our fund, particularly in stocks we've selected relative to the broader SWIX. And this is the bottom-up analysis of our equity team in terms of the value we see in the market. So just to give you guys a sense that we still see a lot of value on our side of the market. I think it's been an incredible journey for us, what's happened with COVID, and it's sharpened our tools, and it's made our research process even more astute and able to handle the crises, any crises into the future, which I think is a critical learning out of this whole process. So that's my conclusion. Thanks.
Vanessa, thank you very much indeed. Courtney Duplessis wants to know from you, saying, we all know South African equities did extremely well over the past 12 months. I mean, artists aren't appreciated in their own lifetime, Vanessa. Van Gogh, his paintings are only valuable now. He wasn't appreciated in his own lifetime. As you were telling us last year and the year before, and the year before, and the year before, there is value to be had. Now, Courtney Duplessis wants to know, will this happen again? You've pointed out the risks. You've told us what you're wary of, but you've also told us about valuations. Your crystal ball worked very well over the last 12 months. What does it tell you about the next 12? Courtney wants to know.
Well, sure, Bruce. I mean, look, the next 12 months, like I said, I mean, we have the protection and the insulation of just much stronger earnings coming through from companies where earnings have been decimated in the last 12 months, and the backdrop of a higher economic growth. But my caution is more going beyond the next 12 months, because I think that the next 12 months is okay from the backdrop point of view, but 2022 onwards, we still haven't got to pre-COVID levels of real GDP. It'll take a couple of years to get back there. So my concern is that you still have to be very risk averse when picking stocks in this area, just given that fact that going forward, it's not a slam dunk past this initial uptick that we're going to see. And then maybe another point to add is, US markets are at all-time highs. Global, you've had a massive run. So there will be an interesting interplay with, what's going to happen to our market if there's a big collapse in the US market, just given the extreme levels of rating it's at the moment. So keep that in the back of your mind as well. So I really just can't, there are so many factors at play. I can't give them an exact guidance, but that's the thing.
Thank you very much. Cor, you were talking about growth rates better than everyone else is expecting. You can't throw that little nugget into the water and then not give us a forecast, please.
Well, we've been saying even at the end of last year, we expect growth this year to be between 4 and 5%. If you just do simple math, if you start with 2019 as your base, 100, and you drop it by 7, takes it to 93. We think that we will get back to 100 quicker than people expect. So if you go from 93 back to 100, you need at least 2 years of very strong growth. Between 4 and 5 is not going to get you back to 100. We were quite amused to see forecast end of last year at 1.9, crept up to 2.5. It's now 3.5, I think. And I see some of the economists are now talking about more than 4%. So we're sticking with our 4 to 5, but we are kind of hoping that maybe we do more than 5. But I won't put that out there as our official expectation.
I think you just did. Last week, the Reserve Bank governor was talking about 4.2%.
Yes.
And that's he's a conservative kind of guy. The Reserve Bank is hyper conservative. So you're suggesting it's possible, you're not putting it out there as an official forecast, of over 5%. In that scenario, then can Vanessa relax a little bit about a small cap portfolio? Can you relax about your SA positioning there?
Yeah, I think so. I think, look, same as the inflation debate, there's lots of base effects. So to post a 5% or a 4% growth number after what's happened last year, it's basically maths. It's not difficult to do. We need 2 years in a row of strong growth. And I think a lot of participants in the market is just going to dismiss whatever the growth. I mean, you see the companies coming out with earnings going up by more than 100. That's just base effects. So we need confidence into 2022 that growth can continue. And I think that's where it's going to start to become interesting next year, when we see inflation not coming down or come down, and whether we see growth being sustained.
Okay, lots of ifs, buts, and maybes. Evan Walker, last thought to you. Tukanam, Badalachalam, sorry, Tukanam. We will see tailwinds for growth in the global economy. Today, Brent crude is at $66 a barrel. We've seen it over 70. Lots of questions around global and us. Vanessa suggesting that global valuations are too high, that there could be a sharp pullback in the United States. Just give me a macro view, if you would, Evan, and then I'll let you guys go, and we'll move into fixed income.
Thanks, Bruce. I mean, there's no doubt that we still got very much a developed market focus, because we're going to see growth in developed markets for the next 3 years way exceed emerging markets, excluding China, just given the vaccination. So, I mean, we're going to be 2 years behind the curve on that, and developed markets will exceed growth emerging markets by a number of fold. And then, as I said in my presentation, you've got this huge pent-up demand, and that pent-up demand has to come through in capital expenditure from companies, and then this big drive to renewables. And as governments throw a lot of capital around the world at invigorating economies, we see this growth rate still continuing at heightened levels for a long time. There's a lot of euphoric action, as Vanessa pointed out, in growth stocks and SPACs, which have been overvalued. But if you look at companies that are still producing strong cash flows, the Microsofts of the world, the Facebooks of the world, even growth companies doing well in reputable sectors, we don't see a slowdown. In fact, we actually see an acceleration towards the latter part of this year and next year, as companies are just on the back foot now with these capital expenditure plans. So we see a big developed market push and a very latent emerging market push once vaccinations are done 24 months down the road.
Does that play out well for us? Before Tanya shouts at us, quick wrap up here, Evan Walker. Does it play out well for South Africa?
Well, it plays out well in terms of our terms of trade. So, I know Cor well. I disagree with him on his fiscal projections, because that's not going to solve anything in South Africa. We still got a 500 billion tax burden, interest burden every year, despite our little bit of a drive. But certainly it's going to bode well for our terms of trade and the rand. And that's, for us, is going to keep inflation at relatively low levels and interest rates at low levels. So, we still think that South African consumer with a job is better off. It doesn't, unfortunately, translate into our retail sectors per se, because we've got 2.5 million people that lost their jobs, and call it 250 million in grant money and external money that came into the base last year. So unfortunately, that's not going to come back fast. And we've got to be very conscious of that in our numbers, because that's a big number, Bruce, and it's not coming back, unfortunately. And the money rolls off this month as we speak. So last of the government initiatives come to an end this month. And then from next month, these companies are going to start to see very tough times. That's just the reality in an environment not creating jobs. Sorry.
No, that's fine. Evan, thank you.
Okay.
Don't apologize. Your views.
No, you had your pen up, and I thought you wanted to hit me with it for a second.
I do, because I want you to stop. And thank you, Evan Walker, very much indeed. Thank you, Vanessa. Thank you, Cor. Wonderful presentations to kick us off today. Let's move on to fixed income, local fixed income. 4 seamless back-to-back presentations for you now. From Argon Asset Management, Ruan Naidu will kick off for us, looking at opportunities in South African government bonds. We've got Glenn Coppins, who's wearing a tie. I saw him earlier, from Investec Specialist Investments. Philip Bradford from Portfolio Metrics, and JP Duplessis from Methodical Investment Management. Let's keep methodical, team. Let's go back to back. And if we've got time, questions will come through. Your questions in the Q&A box, if you would, please, everybody who's watching us today. Let's kick off. Ruan Naidu, you're up first.
Thank you very much, Bruce.
And also just applause for the tie, by the way. That's 2 ties, fixed income guys. Very good, incredible.
Thank you, Bruce.
Best turned out.
We aim to please. So today, talking about opportunities in South African bonds, specifically within the context of portfolio. So looking at asset class performance over the last 5 years, clearly resources have shot the lights out in the black line right at the top. But in second place, we have the All Bond Index, performing quite well relative to the purple line, which is the All Share Index. And below that, the subsectors of industrials in orange, inflation-linked bonds in gray, financials in blue, and in gold, we have property, which is disappointed. But if one has to adjust these cumulative returns for volatility, so taking the returns, dividing it by the volatility over that period, one finds that the All Bond Index provides the best volatility adjusted returns, outperforming resources in the All Share Index, quite a substantial margin relative to the All Share Index. So not only did bonds outperform on an absolute level, the volatility of the All Share Index is about 2.5 times that of the All Bond Index. And resources volatility about 3.5 times that of the All Bond Index. So how do bonds and stocks perform relative to each other in South Africa? The chart on the top, the black line, the All Share Index, red on the left-hand side, and the All Bond in teal, red on the right-hand axis, And at the bottom chart, we have the correlation or the co-movement of these two asset classes. And we see that for most of the time, bonds and stocks are positively correlated above the line, but there are brief periods of negative correlation, and we're going to dig a little deeper into that. So this is where bonds act as a defensive play, really the goalkeeper in the portfolio, while your equities are your strikers. So looking at periods of drawdowns on the left-hand side, you see all-share index drawdowns and how bonds performed over the same period. And we see, for example, at this minus 40% drawdown in the great financial crisis, the bond market cushioned you quite well, with the all bond index generating a return of 16.8%. More recently, during the trade war, when equities fell 12.6%, bonds, cushioned with a 2.4% return. So digging a little bit more into these drawdowns, the maximum drawdown on the left-hand side of the all bond index was about 19.3% using daily data. This happened in the 2020 coronavirus crash. The max drawdown of the all share index about 45% during the great financial crisis. But if one had to take a combined portfolio, 40% stocks, 60% all B, the maximum drawdown gets reduced to 24.5%. So reducing the amount of pain felt in a portfolio during the drawdown. On the right-hand side, we're looking at time periods. So this is measured in days. What we have here is, right at the bottom, maximum drawdown length. So it took 182 days for the equity market to fall and create this maximum drawdown. A much shorter period for the bond market of just 26 days, and the combined portfolio would have been falling for just 32 days. And then how long does it take to recover from this drawdown back to the previous high? It's 714 days for the equity market to get back to its high water mark. Bonds, 227 days. But the combined portfolio, we really reduced amount of time of pain, just 135 days. So your maximum drawdown periods for this combined portfolio really shows that not only do you limit the amount of pain, but it also, for the client, limits the time period of that psychological pain of being in a drawdown. Now looking at some of the return statistics, typical Sharpe ratio and Sortino ratio. So on the left-hand side, we have the Sharpe ratio, all bond index with better risk-adjusted returns relative to stocks over this time period. But if you had to combine these asset classes, you get an even better Sharpe ratio of 0.62, so better than the asset classes on their own. A similar story for the Sortino ratio, where you can really improve the performance of a portfolio by combining stocks and bonds. So clearly there are always risks in the market. So, why would now be a good time to buy bonds? Some of the previous speakers have made some good arguments about the fiscal backdrop, but this looks at things from a more global perspective. We think at Argon that the next catalyst for a big bond rally in the South African market is the global investor buying South African government bonds. This is quite a busy chart, so we'll talk a little bit about what's going on here. So we have a scatter plot with various assets, various markets depicted within the graph. On the left-hand y-axis, on the vertical axis, we have current yield of these assets. And on the x-axis, the horizontal axis, we have a percentile ranking of where this yield is relative to its own history. So further to the left on this chart means that the current yield is very low relative to the asset's history, and on the right, very cheap relative to it, or very high relative to its history. And the dotted or dashed line here is US CPI inflation, which was at 2.6% at the time of production, but currently sitting closer to just north of 4%. So if you need to outperform US CPI, if you need yield as a global investor, where can you go? This circle here shows you developed market bonds, developed market equities, mortgage-backed securities, developed market credit. That's not going to get you inflation-beating returns at this point in time. And not only that, it's also, these yields are very low relative to their sample history. One could go into certain emerging markets, Russia, Brazil, to pick up some yield in excess of US CPI. But again, these instruments are trading quite rich relative to their history. But way on the right here, we find South African bonds, 10-year bonds, trading cheap relative to its historical sample, and also outperforming or exceeding US CPI by quite a long way. So this to us appears to be quite a compelling trade for the global investor that needs to pick up yield. South African government bonds, it would seem that it now is quite an opportune time to pick up some yield. So most of these data points that I've been looking at have all involved the All Bond Index. At Argon Asset Management, we have various products, bond funds, equity funds, flexible income, absolute return, money market funds. But this is our bond fund and its 10-year history relative to the All Bond Index. So just a reminder, one does not necessarily need to go and get the benchmark. One can get benchmark beating returns through a fund. And on the platform, we have the Argon BCI bond fund, which has performed quite well over historical time periods. In 2018 calendar year, ranking 3rd out of 142 funds, outperforming the benchmark with a 9.86 return. In 2019, ranking 5th out of 147 funds, with a strong benchmark beating returns. And in the 12 months to 30th April, ranking 13th on the survey, with a 16.6% return, again outperforming the benchmark. So a quick recap. Absolute returns on bonds have performed quite well relative to other asset classes over history. This remains to be the case if you had to volatility adjust the returns. And if you look at bonds relative to stocks in a portfolio of the two, we find that combining these asset classes helps reduce the amount of pain, with bonds acting as a defensive asset. So not only reducing the amount of pain, but also the time in which this drawdown pain is being felt. Now is a very opportune time to buy bonds if one is searching for yield within a global context. And the Argon Bond Fund, I think, is an excellent fund to take a look at if you are interested in including some bonds in your portfolio. With that, thank you very much.
Hopefully seamless, if you could. So thank you for the opportunity to present and dust off the cobwebs and put on some smart clothes, as Bruce has alluded to. So what we want to talk through today is essentially a topic that's been covered a lot in academic research, a lot of empirical evidence. Time permitting, also probably my technical proficiency probably doesn't allow me to really give massive insight into what we're trying to do. But what we want to focus on is whether persistence exists in the market, and more specifically around from a credit perspective and how that's played out in the South African context over the last year. But maybe just defining what is persistence. I mean, I think we all know those basic examples. Think of Steve Jobs, who was fired from his own company. Michael Jordan didn't make his basketball team in high school. Maybe even the most recent example, Phil Mickelson teaching the young'uns how to play golf. But I think what was evident with all these people is they had this drive to persist, a continuation to exist and define an objective. And that motivated them to achieve a lot of what it was. This is obviously not a motivational talk. So, I mean, what does this have relevance for what we're trying to achieve from an investment management perspective? Well, from this perspective, persistence is the ability to consistently deliver returns above or below the benchmark. Generally, most pundits can agree on, methodology is related to performance, the ability to deliver a level above a return, whatever that defined return or outcome potentially is, but most importantly, to do it consistently. And why this consistent is allows people who are thinking about comparisons between different managers, different asset classes, different investment strategies. It gives you the ability to build solutions with confidence, knowing that there's a fair level of predictability, that the sort of patterns that one's seen will continue to persist as we go forward. But I think, if one does a real quantitative analysis on the research, which has been, running for 25 to 30 years, you get differing levels of results. Probably the only commonality that people tend to believe in is that poor performance tends to persist. But I think persistence definitely depends on the context that one's looking at. It differs on underlying fundamentals, whether one's considering it from the asset class that one thinks about. The term plays a key role. Obviously, the key drivers around market and macro, or what is your risk tolerance? Ultimately, the liquidity that one's thinking about. What is the solution that you're trying to do? All of these have some element around the persistence and the view of persistence. But, let's think about how this is played out. I mean, I think we're all very much aware of this. In traditional portfolio construction, no single asset class or strategy tends to outperform over all time periods. It very much depends on the period that one looks at. When one makes the assumption that the highest performing asset, take something like equities with the highest level of volatility, will have the greatest dispersion over time, and therefore the persistence of that relative to other asset classes will obviously differ, and one needs to frame it from that specific context. But I think what I want to highlight is, when one looks at persistence, most market commentators from an equity perspective over the long term have looked at a normalized basis and said persistence tends to form over 1 to 3 years. But what I want to show you here is that you must be careful of specific pin risk. Be careful of data mining. You really have to be cognizant of the time period that one is analyzing. What we've done here is just take a snapshot of the top 25 managers at the end of March 2021, bearing in mind that the lows of the equity market from a South African perspective was the 23rd of March a year before. So you've had extreme levels of volatility, extreme levels of recovery, those base effects certainly taking hold. But what you found is that despite if you move it 1 month earlier or 1 month later, still looking at a 1 year performance, that level of consistency, those top 25 managers are now very much not the top 25 managers. In fact, a lot of them, we saw, regardless, we saw significant absolute changes from, the top manager performing at 100% down to 60%, whereas most managers now move to different levels of that relative scorecard. And what that does is it provides a lot of uncomfort for asset allocators in terms of how to define, is this performance just based on market fundamentals? Is it very transitory? Is it based on underlying market dynamics? Or is it the skill of that manager that they have conviction that process will endure as they move forward? But I think what we also want to do is analyze from the perspective of credit. So credit in South African context, there's a few key elements that are very much at play in the South African market that one needs to analyze. And what are these credit markets? From a South African perspective, we have to understand that the fundamentals of credit are driven by, what is the security, understanding the differences in the capital structure, understanding how levels of default or the term or from a lack of liquidity ultimately impact the ability of us to deliver returns in a South African context. And I think what's important is, when one considers a fixed income portfolio, we understand that equities are more volatile, but there's definitely this notion from a fixed income perspective that returns are far more constrained. And when returns are more constrained, you like to get better levels of predictability. But I think the difference in a credit portfolio is if you think about an equity manager to produce top quartile performance, if you get 6 out of 10 of your underlying stock selection right, you're probably going to veer towards it being top quartile. However, in the credit space, the key is to avoid defaults. And you want to get as much diversification as possible. You want to avoid idiosyncratic risk because you can't withstand any capital losses. If you take any capital losses, it's going to be very difficult for you to ever recover that return back to a normalized level. Unfortunately, or maybe fortunately, from a South African perspective, we don't have a lot of defaults and understanding those probabilities to determine where that capital losses come from. But if we look at from the US, where the data is obviously a lot better, I think in the context of what we found, a lot of the stimulus that we saw from governments, from banks, obviously helped prop up a lot of the probability and the default levels that we saw. That it may have been the short and sharp recovery that we saw in the markets that meant that we actually, from a default perspective, a lot lower than we were in other recessionary periods historically. How did that play out from the South African perspective? Well, I think we've seen a trend that there's been a general deterioration in credit quality across the board. And we formally understand around SOE and government-backed things, but that has been fundamental across corporates, real estate, banks. We're seeing a bit of a taper off of that more recently as the markets have normalized. But it is definitely a bit of a concern when you do see this tapering off statistic. From the perspective of the universe, I think we need to understand, the South African market has been on a growth cycle for a number of years, going back since we started. And I think you've seen kind of 4 key events that, obviously impacted demand issuance. We've seen that demand issuance change depending on the sort of sector that one is looking at. But those sort of shocks to the system have definitely been transitory in that they were short-term, they were short-lived, but we saw demand pick up again. But you do see that demand changes depending on the nature of what it is. Most certainly in the last few years, we saw a massive uptick from a corporate perspective relative to an SOE. And if we think about where we're sitting now, from the perspective that most of the issuance has been in people wanting to take banking exposure relative to governments. I mean, I think we saw previously that, there's a lot of great yield that one can get from a government perspective, but we've certainly got an anomaly that a lot of banking paper is actually priced more aggressively on tighter than we're seeing on government paper. This is something unprecedented that we haven't seen in the South African context. Obviously, it tells you something about some of the implied and perceived risks in the system. But what it also tells us is around the demand of people looking for banking exposure, which performed really well through this crisis, really well managed, extremely liquid, but also the growth in the corporate sector, where we've seen income funds taking advantage of this over time. If you go back 5 years, none of the property companies were really in the sector, but the demand for high quality corporate has been driven with a lot more demand than supply that we're seeing. That is also having the effect that it's essentially propping up our returns from a yield perspective. And what we've seen, I think what is quite interesting is, when you think about yield, and if you're talking from a credit perspective and you're getting around 1.5 to 2% yield above cash, you're still getting that return now where risk-free is in the region of 3 to 4%, relative to when it was in the region of 7 to 8%. So, on a relative basis, you're actually in a better position. And what we find is when you think about persistence, is that consistency of delivering the same level of return. We saw with a sharp recovery, we saw a massive deterioration in credit spreads. But what you find is that it tends to be fairly directional. You get a lot of comfort from the fact that it tends to be quite directional. You understand where it is. And a lot of those relationships that also hold between various sectors tends to be there. If you think about one bank to another, there might be a 5 basis points difference between spreads from a First Rand to a Nedbank, but that relationship tends to hold. You don't see massive dislocations, especially in high quality and more frequently traded issuers. from the perspective of where we're sitting now, we've actually retraced back to these pre-COVID levels. So you saw a massive pushback up in a lot of credit spreads in March and April. So it was a very difficult time for income funds. But I think we've definitely gone back to a more normalized level. And I think whether these sort of spreads are really a true reflection of the economy is obviously room for debate at another point in time. One of the other factors that we need to think about is from a term perspective. I think when you think about the longer term, most empirical research on credit around persistence has shown that persistency for credit tends to be in the 5 to 10 year domain. You find that the longer you go, the more persistent that return ultimately is. Obviously, smaller changes in that spread does have a material effect, but you find that those tend to price fairly similar over time. What that means is though, especially in more volatile periods like we've seen, you get a lot more opportunity for driving and the search for yield in kind of the 1 to 3 year term. And a lot of those structural elements will remain. And then just lastly, I think kind of one of the interesting dynamics from a South African perspective is, we all know that the fixed income market in South Africa is not that liquid. The investable universe is not really where we want it to be. It most certainly has improved, but the secondary market is there, it is improving. But unfortunately, what you find is that it is still fairly illiquid. A lot more private placement has taken place. And what that tends to do is it unusually tends to prop up prices. So you might find that an instrument doesn't really change in price. It stays the same. It probably shouldn't be there. And what that means is that it shows that falsely, there might actually be a level of consistency around that return. We know that that is not really the case. So we are at the mercy of the illiquidity that we see within our markets. So then just lastly, to conclude, how has that played out from a South African income perspective? Well, I mean, I think from the persistence, one needs to go back to what I mentioned at the outset. The frame of reference is the most important thing that we think about. You're not getting the same level of dispersion that you see in the equity portfolio, but where we've seen massive demand for income funds, you've seen the same dynamics and relationships play out here, that not all income funds that were top quartile remained that way. And you saw a lot more dispersion between managers. You've even seen some survivorship bias take hold of some of those statistics. So in conclusion, I think we realize that this is a topic that has got a lot more to go. I don't think that there's simple answers to it. I really think that you need to consider all factors, most importantly, the dynamics and the frame of reference and the base that you're referring to. And in the last period of time, this has been certainly evident, regardless of the asset class that we're looking at. Thank you very much. I'll leave you with the wise words that we all want to try and predict what's happening in the market, but sometimes we need to just stick to our conviction, keep doing what we need to do, and hopefully we will be able to persist over time.
Excellent.
Philip, Daniel, so we can see your screen, but we're seeing your wrong PowerPoint screen. So if you just want to, you can actually go up. Okay, cool. Just give it another shot.
It's amazing how many times you practice this, you still get it wrong at the wrong time.
There we go. Perfect.
Excellent. Well, thanks everyone for joining us. Apologies, you have to sit through another boring bond talk. There's only so much we can talk about with bonds. At the end of the day, they're just loans and debt. And one of the challenges we've really been dealing with for a number of years now is low interest rates, and particularly since they've halved over the last 18 months in South Africa. And really, how are we going to deal with this going forward? Just very briefly from myself and Portfolio Metrics, for those of you who don't know us, We're a global asset manager with over 10 years of track record now, and we've got operations both in the UK, South Africa, and in Europe, with significant assets as well. And the key sort of points of this, other than introing the company, is we manage multi-assets globally as well. And when you are managing something like fixed income or asset allocation locally, you need to actually have a strong handle on what's happening in the global environment. And this is just myself and the team. Ricardo and myself been working together for the last 7 years, and more recently now Liam, that's part of the team that manages the Dynamic Income Fund that I'm more specifically talking to, but I'm going to be talking about a number of other things as well. If there are any issues with the slides, just let me know. My first question is, well, what's been the best investment in history? What's been a good investment? Well, here's a good example. Here's the Mona Lisa. Leonardo da Vinci died in 1519, and in 1540, his apprentice, Salah, who had inherited the painting, sold it to King Francis I of France for the princely sum, excuse the pun, of $20,000 in today's money. Now, was that a good investment? Well, let's have a look. The insurance value estimate at the moment for the Mona Lisa is $867 million. So that's obviously been an incredible investment, and obviously seen significant growth over that period, but it's obviously over a very, very long period of time. So how good was that investment? And was it the best investment in history? Who was actually smarter? Was it Salah who sold it to King Francis, or was it King Francis himself? Well, the annualized return of this investment over the last 481 years is only 2.25% a year. So while it's been a fantastic investment, it's only resulted in a return that has actually been less than cash and interest rate returns over that period, quite significantly as well. Now, well, if that Mona Lisa with great returns like that wasn't an excellent or the best investment, what was? What about investments like Amazon, Tesla, Microsoft, Facebook, Berkshire Hathaway, and Google? Well, if you'd been the founder of all of these companies, so if you were Jeff Bezos, Elon Musk, Warren Buffett, Bill Gates, who's worth about half of what he was a few weeks ago, Mark Zuckerberg, Warren Buffett, Sergey Brin, and Larry Page, your combined wealth, if you'd founded all those companies, would be worth about $903 billion at the moment, which is obviously an enormous amount of money. So surely these must have been the best investments. Well, interestingly enough, is Salah, who was actually a well-known gambler and reprobate, who probably spent all of this money, had actually just invested this money at 3.75% a year. His wealth currently would be worth more than all of these wealthy men who are pretty much the top 10 wealthiest in the world. There's one that falls out of it. But if he had just done a basic return, which was similar to the cash return over that period, he'd actually be by far the wealthiest person in the world. He'd be pretty much wealthier than the top 10 in the world. So an extra 1.5% a year over a long period of time resulted in an extra $979 billion. Now, if that return had been slightly better, if you'd got actually 4.5% a year, so an extra 1.25, what would have happened? They would be worth now $31 trillion. Now, $31 trillion at the end of 2019 means you could have bought the entire share capital of the S&P 500. So not only like the founders of Google, etc., you would actually own every company in the S&P 500. If you'd got 0.5% more than that, just 5% over the last 481 years, it would be worth $311 trillion. That is worth more than every asset on the planet. That's property, gold, shares, the whole lot. So if he had got 5% a year, now imagine if King Francis had actually just applied that and invested the money on behalf of France. France would effectively own the entire world right now. And more importantly, what if he got even better? What if he got 8% return? 8% being a number I'll come back to later. But if he got 8% return, effectively would have 238 quintillion. I had to look this up on Google. You have trillions, quadrillions, quintillions. And effectively, well, I suppose there's nothing else to buy, so you own the whole universe. So where am I going with all of this? Well, the irony is that bonds over the last 5 years have actually given you just over 8%. They've actually given you 8.5%, 8.67. Now, that in itself, ironically, was not actually a good time for bonds. Bonds actually underperformed the yield of the bonds over that period. And sadly enough, they outperformed equities, property, and other asset classes. And then the income fund portfolios that I've been managing over that period have actually done just about 2% more than that. So bonds actually during a bad time have given you a return that over history would have actually made you basically own everything that's out there. So what is the outlook going forward though? Can bonds continue to give us something similar to that? And the key to understanding this is understanding the global economic and interest rates environment. And I'm going to focus a little bit on the US for a couple of minutes here as well. So, and America being the dominant economy still in the world, America really helps us understand everything else that's happening. This is the US nominal GDP growth per capita over the last, annualized since 1967. So your rolling 20-year growth. And you can see that it's come down from the late 80s all the way down to roughly around 3% at the moment. And we are seeing a blip and we are seeing things improving and everyone's focusing on what's happening over the next year. But this long-term trend is still in place. Importantly, part of that has been driven by inflation. And you can see from 1972 or 1982 onwards, we've seen a downward trend in the US and the rest of the world in the developed markets. And this trend is continuing. We're seeing an improvement in the shorter run, but it's still, we can't ignore the longer term trend. So inflation wasn't the only issue though, because if you actually look at real growth, in other words, growth minus inflation, we've also seen US growth trending down over that same period. Now, why is that? Well, first of all, America is effectively in retirement. You've got more old people than young people. The demographic trend is getting worse and worse, and you can see it trending lower. Europe is worse than this. Japan is worse than this. China one day has this problem. It's still growing, but at some stage it's going to be an issue. The point here is you can see a very strong link between population growth and GDP growth. So the real formula for GDP is really population growth and productivity. Now, productivity is very much about labor participation as well. And you can see here the employment population ratio is also trending downwards, and particularly over the last 20 years. This means that the amount of people employed per population is actually been decreasing. So despite a lot of noise in the US at the moment around tight labor markets, etc., you can see that there's actually less and less people relative to the population that are being employed. And what we're finding, particularly post-COVID, is a lot of women are leaving the workforce. We're getting quite a lot of older people, ironically. It's the one area that's growing, between 55 to 64 coming into the market. But ironically, that's taking pressure off wages because the people don't have as much bargaining power for wages anymore. Then what we've got on top of this is debt. So what the US has been doing, and we've been seeing in Europe as well, is they've been trying to grow their way out of this slow growth by issuing debt and trying to spend that money on the economy. And you can see if you go back from 2009 to where we are currently, the GDP growth versus the debt has been, GDP's been going along here and debt's been increasing exponentially, and particularly over this last year. So much so that it now takes over $5 of debt spending to create $1 of growth. So it's a bit like a drug addict that has to take an additional hit of that debt just to get that same amount of growth every time. And if we look at it, it goes back even further. Here's showing how that ratio has changed from less than $2 to get $1 of growth in the 60s to over 5 now. And all this time, growth has actually been coming down because it's as simple as we've got a longer term, slower trend. And this is very, very important to understand because this has a dramatic impact on interest rates all around the world, and particularly in South Africa. And we can see that we can rattle our saber as much as we want around inflation, but we can only really cut interest rates when interest rates are lower in the rest of the world. And this environment points us to a much lower for longer interest rate environment locally and globally. And the US is effectively going to have to continue to increase its debt just to sustain its growth. So what does this mean? Now, we know over the last many years, we used to have much, much higher interest rates. In the early 2000s, our repo rate in the dark blue line was over 12. 2008, 2009, it was also around 12 again. And you can see how income funds and money market returns follow the cycle very closely. If we go through to like the multi-asset income funds, which take a bit more bond risk, you can see the trend is the same. So managers and the assets that we buy have been trending downwards the whole time. But the bond market is actually quite attractively priced. So the bonds don't only invest in shorter term rates, they have longer term rates as well. And what we know from history, in fact, we've invested when yields are roughly where they are at the moment in this 9.5% to 10% range, you're typically getting between 7.5% to 13% returns, and on average around 9 or 10. The problem is a lot of that data included a very much lower interest rate environment. Bonds over time, as we know, only give us income. So really what you want over time from bonds is to lock in a yield at a high level and hold it through, because you don't really get capital gain because it's effectively like a fixed deposit. Now, the opportunity for us here is the gap between our interest rates and the Europe and US interest rates are pretty much the highest they've ever been for the longer dated bonds. The shorter dated bonds over here are not so much. So if we have a look here, this gap has narrowed significantly and changed over the last 20 years, the 20 years that I've been involved in the bond market. We've gone from an environment at one stage where the 20-year rates were 2 to 3% lower than the 2-year rates, and they're now 6% higher. So this creates an incredible opportunity, but it also there's risk attached to that. So this is the opportunity here. Shorter dated bonds are offering much lower yields. In other words, they've appreciated a lot in the last year or so. But longer dated bonds are still giving us better returns. They're probably the only risky asset in the world that is cheaper now than it was just about during the coronavirus. And you can see this gap here. It's even wider. Everything else has appreciated where our bonds haven't yet, and particularly the longer dated bonds. So what I'm really saying is you want to hold the longer dated, you're not going to get as good a returns from the shorter dated bonds. And this just shows you monthly returns of the All Bond Index. We heard it earlier from Ruan as well. You had a 19% drawdown last year from point to point on bonds. So bonds are very volatile for a very short period of time. But if you look at it over a rolling 12-month period, it's very seldom that you have a negative return over a 12-month period. So now this is really the true story here. As an institutional investor right now, I can get 3% out of cash. I can get 4.5% out of a Standard Bank floating rate bond, but over here, just under 5. But the same Standard Bank 5-year bond, I can get 7%. The Standard Bank 10-year bond, I can get just under 9%, 8.7. And the government bonds, which the yields have dropped to just a bit below this over the last week, but are giving me between 9 and 11% type returns. So that's incredibly attractive. So in order for me to generate a 7% portfolio return, I can take 50% invested in traditional floating rate bank credit bonds. I can put 40% into fixed rate government bonds, very liquid bonds, and I can have the rest sitting in cash. So this very high yield that we've got at the moment, the luxury of this is it's allowing us to not take too much risk to generate a decent type return. And in the portfolio that we're managing at the moment, the Dynamic Income Fund, we're sitting with a yield of just over 8%. And to get that 8%, we've actually got a third of the exposure to the bond market. So roughly about 40% or a third of the interest rate volatility of the bond market. And if you look here, this is great at the moment. It's really like a car where we can go 180, but if we go 180, we can get into serious trouble. But we only need to go at 100. We're traveling at 100 kilometers an hour with only 30-odd% in the bond market at the moment. And what's very powerful about that is if there is a sell-off, and there will be a sell-off sometime between now and the end of the year as markets pull back, it allows us to then invest into that weakness and lock in much higher yields. So just running out of time here quickly. Over time, this strategy has worked very, very well for us. It allows us to just adding some bonds to the portfolio. It's a bit like adding a bit of chili to your meal. That additional spice has given us 2 to 3% more performance over the peers and the bond market over time. The shorter term year to date as well, it's allowed us to avoid most of the trouble of the bond market and still produce very good risk-adjusted returns. So the key here is you don't want to only invest in the bond market, because the all bond index has high yielding and low yielding bonds. You want to only invest in the ones that are the most attractive, and then the rest of those, the portfolio, we sit in companies like Standard Bank, Nedbank, ABSA, etc., with much lower volatility bonds that gives us those kinds of returns. So just whipping through that quickly, global and local interest rates are likely to stay lower. Bonds are likely to give you good returns. And an 8% bird in hand is worth two in the bush. That 8% roughly that we're offering at the moment is allowing us to not be greedy. We can still get a return that would have been exceptional to return without history, with a very low volatility. And that allows us, when there is a pullback in the markets, be it equities or bonds, to then allocate into that area. Thanks very much.
Okay, good morning, everybody. Firstly, I must apologize to Bruce, no tie, and I also didn't get the memo about the haircut and looking after the beard, so I apologize to Bruce on that front. I'm just going to share my my presentation here. Hopefully you can see that.
Yep, JP, we can see your PowerPoint screen. You'll just need to go into slideshow.
There we go. Okay, so I'm going to be talking about opportunities in the fixed income space, but also I think importantly talking about the risks that are out there in the fixed income space. So yes, there's opportunities, but also risks. So the discussion points today are just briefly talking about what are the client's objectives? What are you as the investors or the end investors trying to achieve for the various funds that we run? We run an income fund as well as a bond fund, and just looking at both of those mandates. I'm going to talk briefly about what's available in the income fund, what opportunities there are out there in the income space. Again, what are the risks for those opportunities? And then the bond fund as well. What are the opportunities in the bond space? What kind of returns are available? That's what I'm going to talk about today. I saw this quote a couple of days ago, and I thought it was particularly a good one by Jeff Bezos, who, when he talked about the secret sauce of Amazon's success, was the obsessive compulsion on the customer rather than the competition. So don't spend time thinking about the competition. Think about what the customer wants. And when I think about what the customer wants, I'm thinking about what does an income investor want? What is a bond fund investor? And how does that translate into how I run those portfolios? So an income investor wants real returns. The investor wants returns over and above inflation, but it wants that in a risk-controlled way. Doesn't want to see big drawdowns. Typically, living annuity, they're drawing down on the fund. They don't want to see huge amounts of volatility. So we have this sort of no loss over rolling 3-month mandate as well. So it's important to run the fund with that risk constraint in mind. It's not all about just trying to make big returns, but actually making the highest returns we can within those risk constraints. The bond fund investor is typically looking for, again, high real returns, but what really wants the bond fund manager to manage the volatility and pick the best parts of the bond curve to take advantage of. So do it in a risk-adjusted way again. Just briefly, I thought I'd give some thoughts about how you manage risk within an income fund. And if you think just conceptually, very roughly, if you have 10% yield in an income fund, you've got about 2.5% every 3 months before you go below zero. So you've got that sort of 2.5% buffer from the yield. But obviously, if those yields are substantially lower, as you can see, if it's 3.5% yields in an income fund, then you've got less than 1% of a buffer over that rolling 3-month period. So you have to be a lot more concentrated on your risk when you have lower yields than you need to be when you have high yields in those portfolios. So this is the universe. I haven't included the Mona Lisa here, sorry, Philip, but this is the universe that I look at in the income fund. We go all the way from money market out to risky assets, property, offshore equity. And I'm going to talk about a few of these asset classes, not all of them, but where I'm seeing opportunities at the moment. So the first place to look really, or the first place to think about when we manage an income fund is, where's inflation going to be? And it's been briefly touched on by a number of the presenters today. And then what is the Reserve Bank's reaction function going to be to that inflation? So if inflation starts to pick up, how is the Reserve Bank going to react to that? And I think it's a global question, when you look at central bank policy right now. So this is what this is from the Reserve Bank themselves. And you can see that they expected, this is before the most recent CPI print, but they expected CPI to go back to that middle of the range, that sort of 4.5% range. And obviously, last month it went to 4.4 on an annualized basis. So we've seen that sort of normalization on the left-hand chart of where they expect inflation to go. But on the right-hand chart, you can see that the Reserve Bank expects real rates, i.e. the interest rates versus where inflation is, to be negative. So they expect our rates, our interest rates, to be lower than inflation for quite a considerable period of time. And even this is probably, being a bit optimistic about their ability to increase rates from here. So the long and short of it is, interest rates are likely to be low for a reasonably long period of time. We could be looking 18 to 24 months out before we even start to see some movement in interest rates, even with a sort of normalization of inflation. When we look at the yield curve, we can see it's particularly steep. This was on the back of the 3.2% inflation. Obviously, that inflation has increased now. So if you think about that, the short end of the curve, there's not really a lot of real returns. In fact, it's pretty much flat and actually negative now in real return basis. So you have to go along out the curve to get those real returns. So they're now sort of more like 4 and 6, but they're still attractive real returns when you're pushing out the curve. But when you do push out the curve and you do add duration to the portfolio, you are increasing the risk. So one has to think about that in terms of an income portfolio. An interesting place for me at the moment is inflation-linked bonds. If you see on this chart in front of you, the black curve is the nominal curve, the fixed rate curve. The blue curve is the real rate curve, the inflation-linked bond curve. And you can see you can still get, in the sort of 4-year, 5-year space, 2% real rates. The red dots are the break-even rates. So that just shows you what inflation rate you need and above to break even in owning inflation-linked bonds. And you can see that in the short end, they're all in the 3s. So if inflation is anywhere 4 and above, then you're better off being in inflation-linked bonds than in fixed-rate bonds. Another asset class that I'm going to talk about briefly is property. Not a favorite asset class for me at the moment. If you look at, on the left-hand side, you're looking at the historical rolling dividend yield, spiked dramatically during the crisis last year, almost 20%, and it's come down to 4% now. On the right-hand side, you can see the rolling 12-month performance, a very volatile asset class. So I'm not saying it doesn't have attractiveness at points in time, but you are talking about a very volatile asset class. And at the moment, I don't think you're getting the returns that are necessary to include in an income portfolio. So the Rand, briefly on the Rand, I like having some dollar exposure in the income fund because I see it as a risk mitigator in the income fund. It hasn't been of late, but over the longer term, you can see on the right-hand side, the right-hand side shows you the longer term correlations or negative correlations between some of our bonds, the R186, R2035, R2048, to the Rand dollar. And you can see that typically they are negatively correlated to the dollar. On the left-hand side, you can see that even versus our EM peers, this is a chart, this is of the Rand versus our EM peers, we're particularly strong. So just taking out any concerns you might have of the dollar, if you look at the Rand versus EM peers, we know a lot of that's around our terms of trade, but it is particularly strong at the moment. This is how the income fund's positioned at the moment. And you can see a decent yield, but only about 1.5 years of duration. So I'm conservatively positioned in duration. I do like those shorter dated ILBs. Briefly on the bond fund, one slide on fundamentals. I think fundamentals, to some respect, are a little bit old-fashioned at the moment. But if we compare what we're seeing on our government bond yields, we deconstruct what those risks are. We kind of take a risk-free rate for the US Treasury. We add what the credit spread you need to buy, South African government bonds in dollars. That 2.9% is that CDS spread. Then it gives you a balance which you can use to infer what the market thinks inflation needs to be over the longer term to warrant buying that bond. And you can see that at 7.6%, that's an extremely high inflation, implied inflation in our bonds from a fundamental perspective. We've seen this as we go up the curve, you can get those real returns. What you'll also notice about our bond curve, if you look on the right-hand side of this graph, is that it gets particularly flat as you go further out. So I don't think you're not picking up additional yield or significant additional yield by adding duration in that longer term space. This graph just shows you the South African 10-year yield curve versus the 10-year US yield curve. And you can see it spiked dramatically during the crisis. We saw foreign selling, a big sell-off in our bonds, and we have recovered since then. But we still now, if you look on the bump on the left, that was Nenegate. That spread in Nenegate, we're still sort of at those sort of levels now. And we would argue that we're in a slightly better position than we were in terms of fiscal, not necessarily fiscal picture, but over reform picture than we were in Nenegate. So there still is juice in our curve. What we've seen over the last few months is actually improvement from very, very pessimistic, very pessimistic outlook. So in the MTPPS last year, when National Treasury looked at our budget, they were expecting very significant budget deficits. And then as we've seen the end of last year, growth was better than expected. We've seen budget deficits partly as a result of our economy mix has been better than expected. And you can see on the right-hand chart, the expectation for that peaking of our debt to GDP has actually come in. So that is a better picture than we were seeing at the MTPPS last October. Obviously, that was from a very low base. This chart just shows you the issuance that we've seen from National Treasury. On the y-axis, you can see here is the bond maturity. So the red line, if you look at the red line, you can see that National Treasury has been pretty disciplined in actually issuing very longer dated bonds, and it's a good discipline because it does mean when you do have a crisis that you're not necessarily requiring a big rollover of debt at any point in time. You can see during the crisis, if we go here to March, April of last year, that National Treasury was bringing down that length of bond maturity, but they could in some ways afford to do that because of the debt maturity that we already had. But now, as we see some recovery, they've started to lengthen out that maturity, and we're going to start to see that we still need a lot of bond issuance, and that bond issuance is going to come towards the back end of the curve. Again, the inflation picture, we talk about the US 10-year, US 10-year versus US 10-year inflation swaps. You can see that they generally move in lockstep. Inflation expectations in the US has increased, and we've seen some sell-off in US 10-year treasuries, but there is still some gap for future selling off. So it's still a risk. It's still a risk that we see higher US Treasury yields. Well, what happened last year from a kind of demand supply perspective was a large amount of selling. On the left-hand side, you can see on the gray dots, this is last year, 2020, we saw a lot of foreign selling of our bonds. They were quite large owners of our bond market, in the high 30% of our bond market, and they reduced that significantly with the falling out with the downgrades to below investment grade and leaving the bond indices. We saw that foreign selling. Well, who picked that up? The banks. On the right-hand side, you can see that the banks took up a lot of that slack, but they're now at levels where they are pretty full of South African government bonds. So it really does require another purchaser coming into our market and foreigners potentially coming back into our market. The fiscal challenges remain. So you can see here, I know we had no movement from Fitch and S&P last week, but if we look at what Moody's is saying, if we look at what Fitch is saying, they're still seeing risks to our fiscal picture. So what I'm saying here is I see a lot of attractive yields on our bond curve, but there are still risks that remain in fiscally. So one has to keep an eye on that. And if I look at how I'm positioned in our bond fund launched in February of this year, I am a bit short in the longer end. With that, that's where the issuance is going to be coming, but taking advantage of the high yields that you're getting in that 10 to 15 year part of the curve. So in conclusion, we're in a low yield environment. I don't think it's going to change. Generating real returns is challenging, but you do have to go a little bit further out the curve, look at other asset classes like ILBs and to generate return. I think you do need to be careful about how much duration you have in the portfolio. You don't want to be going too far along the curve because duration is risk. You need to pay attention to how much risk you're having in the portfolio. In the bond fund, great value, I think, in bonds, but there are still these risks. We are still subject to those foreign flows. We still have significant fiscal challenges. So those can produce periods and bouts of volatility. And that's me.
Quick question before you go. Zietswater sees SA government bonds as risk-free. Do you see them as risk-free? And if you do see them as low risk, how much longer can they remain, as Zietz puts it, risk-free?
Well, I guess risk-free is in the eye of the beholder. The risk-free, the way that you kind of look at a risk-free is, oh, well, you know, am I going to get my money back? And I don't think you're going to see a default as a Rand investor in our government bonds. I think you will get your Rands back. The question mark for me is how many Rands, you know, how many dollars does that Rand buy when you ultimately get it back? There are a lot of ways for us to fund our deficits. I don't think we're at the last resort. We've gone to the new development bank. You know, there's a lot of ways that we can go. The markets are still very much open to our issuance. So we're far from an environment where we need to, you know, panic. But you know, the real risk actually is not so much that you don't get your money back, but actually that when you do, it's not worth a lot of money in dollars.
Thank you for that. Then if you can stop sharing your screen, if you don't mind, JP,
Yeah.
and then Corné Duplessis, to you, Philip. I mean, are you as optimistic as JP is in terms of the default picture? Because Corné is saying, do we as South Africans stand a real chance of the South African government defaulting on the repayment of the coupons on government bonds, especially the 10-year bonds? JP doesn't see an SA default, but is worried about the currency, clearly.
Yeah, well, first of all, I think, what does a default actually mean? You know, bond default is, you don't lose all your money. You know, even in a proper default, normally what happens is the debt gets restructured. At the very worst, you take like a haircut, like we saw with African Bank at the likes, you maybe lose 10% of the capital, okay? And in a government scenario, what it probably means is your 2-year government bonds become 30-year government bonds, you know, and the point is the can gets kicked down the road. The thing that will, as JP very clearly pointed out there, and we can see it with Russia when they defaulted, the ruble went from like 5 to the dollar to 40 to the dollar. So that is the what is likely to happen. And ironically, the government bonds are probably one of the safer places to be if we do get into problems from a default, because your likes of property, retailers, equity, all of those, you know, those are going to fall a lot. So I don't think the likelihood of a default is quite remote, but long before we get to the default, so the bond market's the smart market, it's looking ahead. Your Rand will be at 30 or 40 before we get there. So that's I think that natural hedge. And for me, actually, rather than buying currency in this hedge in this portfolio, I actually have that in my multi-asset. So it could be global equities and the like. So your best protection against problems in South Africa is not local equities or something like that, or a Rand hedge. It's probably dollar assets.
Okay, thank you very much for that. To you, Glenn, I saw you smiling at 30, 40 to the dollar.
I don't know if we'd be smiling at that, but
was it a grimace or a smile? Ludwig Harmser, how many interest rate hikes has the bond market priced in? What's your view on the potential of rate hikes over the next 12 months? Certainly the Reserve Bank governor was avoiding that like the plague last week, but your view?
Yeah, look, I think it's shared around consensus. I mean, I think it's very difficult in an environment like this to start looking for increases. I mean, I think the likely expectation is you probably will see the first change early next quarter. it's going to be gradual. I think one has to be cognizant of the fiscal challenges we have, stimulating growth. It's balancing those factors. Unfortunately, I think you have seen some benefits of these lower rates, feeding back into, for instance, house prices and house sales, and the consumer. I think, as a few guys have shown already, the consumer-driven cycle that we have seen. And I think if you can remain low for longer, I think ultimately it will help propel the sort of growth trajectory that we're looking for. But I think the expectation is that it's a little bit further down the road. So for now, I think that government versus, cash position that Phil and Jean-Pierre have alluded to, I think will definitely remain and persist with some seriously good real yields from that environment.
Thank you. And then last one for you, Rowan. The question is, what will be the catalyst for foreign buyers to return? Is there a trigger event? Is it going to be dependent on factors combining improved governance, fiscal discipline, all the regular questions we ask? The one from Peter Hamp Adams for you, Rowan.
Thanks, Bruce. Yeah, very good question. Certainly fundamental factors, improving fiscal position, better revenues, that usually would be a trigger. But when we look at flows, there are two types of flows that we look at. Flows into EM bond funds and then flows within EM bond funds. Flows into EM bond funds have started to pick up over the last few weeks. And that typically follows global liquidity with a lag. When we look at global liquidity creation by the big central banks, eventually that washes into the shores of EM bond funds. Then when we look at flows within EM bond funds, and you look at the performance of various countries, South Africa and China are two of the only EM countries that have positive returns within the EM bond space. And positioning within these global EM bond funds is underweight South Africa. So it's what I like to call the pain trade. The pain trade is to be underweight South Africa. So at some point, with global liquidity washing into the shores of EM, one has to cover that underweight. And sometimes a trigger is something within the system, like a covering of an underweight position. That could be a potential gap.
All right, Ron, thank you very much indeed. Taking us to tea time. 20-minute break, please, guys. We're going to start sharp at 20 past 11 South Africa time. Please make sure that you're back in the room for that. Meantime, go and stretch your legs, and we will get to that. And of course, more of the questions. If you haven't got to the questions, your questions answered, you've got questions you don't want to put on the public forum, there are going to be the breakaway sessions. Those breakaway sessions starting after the last talk about 25 past 1 or thereabouts. You can get all the details on how to do that in the chat button. The chat button where it is now. It does explain to you very, very clearly how you will be able to get into the room that you want to get into with any one of the fund managers that you're hearing speak today. Tea break time, 20 past 11. We're getting started once again. Your questions are great. Keep those coming through in the Q&A box. The chat box has got the details of where to go for the breakaway sessions coming up later. 20 past 11. See you in a moment. I mean, that is really impeccable timing, Dan. Impeccable timing. And if you don't like the music, by the way, DJ Dizzy Dan, who's really in charge of everything, so we shouldn't be rude about him. The complaints department is about 50 kilometers offshore Robben Island to the south. So if you'd like to post complaints on a postcard via the South African Post Office, please be our guest. Otherwise, enjoy the tunes. Dan, well done. I think especially you lifted the mood. You lifted the mood with a bit of Mango Groove at the end there as well. On to the next part of today's program. Remember, questions in the Q&A box, please, if you would. And then the details of the breakaway sessions, which I will brief you on in a little bit more detail. 1. Those are in the chat box so that you can familiarize yourself and join the presenters of the various sections that you want to participate in. We're going to look global and local property. Evan Jankelowitz is with us. He has put a jacket on. Excellent. Well done, Evan. And then from Sesfikile Capital, and from Reachway Global, Gareth Elston's going to join us as well. But first to you, Evan Jankelowitz, with a tie nogal as well.
The tie as well.
You're pulling up the stops. You really are. Carry on.
I must admit, I saw 1,000 people, and I'm getting a little bit nervous for the first time in a long time. So, presenting 101, they say just picture your audience naked. So at this time, I'd like everyone to please put on their videos just to make me feel a little bit more at home. But really, you can see I'm assuming you can see my presentation.
Not yet. Dan, coach you through that one, I think, Evan.
You should be able to now.
It's working. It's working.
Okay. So we're going to speak about a local listed property. How deep is deep enough with regards to the value tilt? And, one thing I learned from this heading is that you should never, ever submit a presentation heading 3 months in advance, because unfortunately the market has run quite substantially since then. But with that all said and done, is that let's go on to see where the value is, or where the value was for that matter. So obviously you can see the big dip into COVID. And, if you look at this time period over here, you saw the collapse, and it was probably far too aggressive relative to the movement in the absolute fundamentals. And there was a lack of transparency. That's why the risk of people didn't really know what to expect. So if you had the stomach, you could have bought into this deep value. And that's what investing is all about. You've got to see through this, and hence value came to the fore. However, we see that's kind of the value gap. You see that top line is where we see fair value. And after the initial dip, the market really moved sideways for quite a while, until what we call, Pfizer Tuesday, when the vaccine rally came through right at the beginning of the beginning of October. It was risk on, high quality really lagged, and you saw money indiscriminately chasing higher yields. So the opportunity set was very different. The money was chasing the lesser quality stocks, and you saw a significant rally in those 2 months. We thought that was probably it for the time being. We actually saw January take a little bit of a breather, but what you saw subsequent to that, February, March, April, the reopening rally, the sector forged ahead all the way towards fair value. Where we sit now, as I say, that we believe that the market is at fair value, but with that all said and done, is that there are certain stocks that are expensive, and on the flip side, certain stocks that are cheap. So now where we are now, unfortunately, if you look at this total return that we kind of promised last year this time of 35%, I must apologize. I was laughed off the stage at the time, or the proverbial stage, but we didn't deliver 34 or 35%. It was probably closer to 44%. Unfortunately, we're not looking at that kind of return right now. We are not looking at deep value. We are looking at fair value. At the moment, in the next 12 months, of a distributable or distribution that we should be getting of 8.1%, that's because companies are holding back some distributions now. So the actual distributable yield is closer to about 10.3%. They're holding back circa, at the moment on average 18%. And we are looking at a total return of 9.3%. Not quite as exciting as 35%, but it will do. It is fair value. To be neutral in property is, I don't believe, a mistake at this point in time. And we do believe that it will normalize to circa 12% in the next, we'll call it 3, 5, 10 years. Why is that? You're starting off an 8% yield. We're only looking for capital growth of 4%, which is pretty much in line with inflation. An IRR of 12% is acceptable and very much doable in the next or the foreseeable future, we do believe. And, unfortunately, we were jumping up and down and saying there's 35% or so at this period of time where there was deep value. This mustard line is your property yields divided by your bond yields. So you can see significant value at this stage. The blue line is the inverted growth. So you can see the market was cheap because there was no growth. However, it's kind of come through all the way to fair value as growth has increased, albeit of a very low base. If you don't look at cash flows, if you just look at price to NAV, you can see we are still trading at a 20% discount to NAV. And, you know, people say, well, you know, the value was there when you were trading at, call it 50% discount to NAV. But at that point of time, we hadn't had the write-offs. We hadn't had the cut in valuations. And, you know, where we're sitting now at a 20% discount to NAV, we've already seen some significant cut in valuations. So I think that's, you know, more than fair. The market is still implying another, call it 12% cut towards fair value of valuations. We don't think it will be that aggressive. And if we move away from valuations, let's see what's happening on the ground. Well, you know, we saw in the initial stages of COVID, it was somewhat dire, where you saw collections circa 80% for the sectors, actually closer to 70%, were already weighed down by what we saw in retail, where the collections were sub 50%. It has consistently increased, you know, all the way to where we're standing on, call it normalized at around about 98%. So we've seen steady improvements from a very dire base, and with more clarity on valuations. What I've got here on the bottom right is the movements in valuations on the first round of results after COVID. You can see they were more dramatic. Subsequent, you can see very small cuts in valuations. Now, some cases increases, but it is not as material. Why? Is because there's more clarity. Just one thing to point out, you saw the steady improvement in collections. You know, all the way, the big improvements came through in the earlier months where you saw the lockdowns, you know, ease. However, we only saw the sector really rally in October, November. So it had very little to do with the actual earnings and more to do with the macro risks on climate. Just to speak on those valuations, and one of the big things that we were worried about up front was breaching covenants, the balance sheets. You can see where we are now. Your covenants are these little gray dots, whereas your actual loan to value is sitting at the mustard lines. We made a few adjustments here and there, but pretty much all of the companies are in a safe position. Why? Is because they had many tools at their disposal. They had the ability, you know, they had the slower valuation write-downs, which is not really their tool, their asset disposals, ability to retain earnings, access to potential capital markets, and very rational banking partners. The banks were very rational and, you know, we'll say complementary to the property companies, allowing them to get through the initial dip. And here's the actual evidence. Growth Point, never mind, they raised 4 billion through a capital raise and sold 500 million of assets. Attack sold 600 million of assets. Now you can read the list at your own leisure, but these guys had the ability to fix their balance sheets during a very, very weak time. So people were saying, well, how are you going to sell any assets? Well, over 20 billion rands worth of assets were sold through the COVID period. So let's speak about the underlying asset classes. Initially, we're speaking about retail. Retail was very interesting because it was better than expected, but very uneven. Now, why is that? If you look at the categories, the performance in luxury brands were up 28%. People weren't traveling. They were buying luxury brands if you had the money. Grocery spend was up 13%, while department stores, more the middle market discretionary items, you saw them down 19%. Also, convenience, neighborhood, more lower LSM assets did very well, whereas mid-market, regional, and super regionals did worse. And you can see from this this table up here, you know, your value marts, your strip centers did nicely year on year, whereas if you look at the likes of Rosebank Mall, Hyde Park, Somerset, Eastgate, Sandton, they really didn't do well because people didn't want to be in closed areas, and you know the more discretionary middle markets didn't fare as well. And that's why you saw the likes of Liberty 2 Degrees and Hyprop, their renewals, the rental reversions on renewals were at stages on Liberty more than 30% down. And you can see those two companies, which really hold the bulk of these types of centers, took the biggest knock. But on the positive side is that they would rather retain their tenants. So they cut rentals on renewals, but they still had, if you look at this, Hyprop vacancies at 3%, steady occupancy levels through a very dire scenario. So ultimately, it really wasn't that bad an outcome for the retailers, and it was really buoyed by the better than expected results in the likes of the SA retailers, such as the likes of TFG and Truworths. And there's always that kind of, you know, that pesky online what impact did that have and what impact will it have to retail? There's been a steady increase of the number or the amount of guys shopping online, and everyone's doing it. So it's not only the Takealots of the world, whether you're Woolies or Pick n Pay or ShopRite, everyone's got an online, an online angle, which you can say, or you should assume that it could be a bit of a threat to your bricks and mortar. But you saw the online increase by circa 2% all the way to 7% at the peak. It's come all the way back to circa 3 to 4%. And South Africa, even though will have developed elements to our retailing markets, we're still not in line with the likes of the UK, which went from 20 to 35% online shopping. So I don't think that this will have as big an impact to the bricks and mortar, especially where a lot of these guys, if you look at that list, have they use their stores as depots, as well as the fact that your kind of bricks and mortar is really your brand as well. Where we are worried, so we're actually quite happy with retail, but we're very worried when it comes to office, because office, it's all an indicator, or it really much tracks where GDP is. So we might get a little bit of a spark, coming when GDP sparks off the very kind of lows. But the truth of the matter is office is under pressure. You can see the vacancies push up for the first time in, call it over 12, 13 years over the medium average. Vacancies at the moment are 13.3%. And that's an optimistic number because there's still a lot of gray space, meaning the sublet space that is actually increasing the vacancy level. P grade vacancies are sitting north of 11.5%. That's your prime, assets that are sitting in the likes of Sandton and Rosebank, so over 11.5% at the moment. A grade is sitting at 10.8%, and rental reversions are quite negative as well at minus 15%. If I wanted to paint a little bit of a happier note there, if I can, is that your supply side is also non-existent. At only 0.6% of the stock being developed, it really isn't much. And then it comes down to people say, well, what about work from home? People are saying, we're not going to sign new leases. We want to see how this flexible working works. Well, I can say to you is that, if people say there's better productivity, work-life balance, I often prefer to, work at a distance from my family. And I'm getting a bit of a death stare over there because my wife is standing next to me. But the truth of the matter is, personally, I don't enjoy working at home. I don't think we're more efficient. What about the guys that want to, if you look at this graph over here, there's a range of, preferences. People don't want to work. Some people want to work at home completely, permanently, some 2-3 days a week. Offices can't be built on that flexibility because you've got to have office space for peaks. And also social distancing. Historically, we've come to this, shared working space where the actual square meterage per individual came all the way from 60 square meters down to 15 because of social distancing and the lack of trust we have with each other. Well, I think that will go up again, and I think you'll need more space for that. And ultimately, you'll also need more space for these Zoom conferences, Zoom meetings. You can't sit in an open plan with all the noise around you and have these kind of discussions. Also, to be very honest, I don't think we're that efficient. I would love to see a show of hands. How many people right now are sitting on their phones? It's something you wouldn't really do back in the office as well. Really what we think is work from home will take away circa 10% of the demand. That's probably structural, but it's not an all fall down. The issue we're having with the office sector is really GDP. And then we go to the final of the major sectors, is trying to work this, is industrial or warehousing. Having a bit of a problem there. But the truth of the matter is warehousing has been very solid, very stable. Why? Is because, yes, they've had headwinds, but they've also had the tailwinds of the extrapolation of online trade, people needing separate warehouses or more warehouse facilities in, the infill so they can get to you within that kind of 60 minutes. And, that has really been call it a tailwind for industrial. I wouldn't say it's shooting the lights out, but it is very stable. And I think the valuations are very fair and offer quite decent value. Ultimately, in a final side, is that we speak about deep value. We've learned a very big lesson here. Everything has a price. And I'm getting that death stare again, but really everything has a price. It's all about fear and value. What can we fear right now? COVID, but probably less so. And I'm going from in ascending order here. I think Eskom is unfortunately not out the way. No, I think that that COVID took a lot of the limelight away from Eskom. But the truth of the matter is that you've got to have that impact, or Eskom's impact on the economy could be quite dire. We need the economy to start pushing ahead in order to kind of support the office markets, in order to support retail as well. And then lastly, I think more of a short-term impact is interest rates. Yes, we heard from our previous individuals that the short-term rate is not going, that we're not really worried, sorry, the long bonds, we're not worried in South Africa because we have a buffer, but I'm concerned about that inflation creep globally and what kind of push that will have on EM. On the support side, well, we can be a bit greedy because this man is still there and he's smiling a lot more. So his reforms are able to be implemented a lot easier than they were this time last year. We are seeing green shoots across several sectors, especially what we've seen coming out of resources of late, which is obviously a tailwind to the economy. The technicals are in support of property. A lot more investors, especially generalists, have kind of shaken off the turmoil we've seen in property in the last 3 years. And we've seen, especially ourselves, we've seen a lot more demand for the sector. And then lastly, it's all about finding a balance between value and price. And we believe at the moment, we've got that value, we've got that perfect balance at 9.3%. We believe we're sitting at fair value. And I know I've gone over my time, so I will pass on to Bruce.
Thanks very much, Evan. If you can stop sharing, please, and then Gareth will seamlessly take over.
Okay, I will de-share. Have you got me off there?
Yes, Evan, I stopped your screen share.
Excellent.
Gareth, you can share your screen, unmute when you're ready. There we go.
Okay, great, excellent. I'm assuming everything's showing there. And again, thanks to everyone for joining today. I think it's a fabulous turnout we have today, and I think that's the one plus we have from these virtual conferences, that we can have so many more people. But yeah, I think everyone really wants to get face to face sooner rather than later. Just again, what we'd like to focus on today is again to just keep reminding, I think most journalists, South African investors about property, especially looking at global property, is we are looking at a very broad asset class in the international sense that not only spans the globe, but the way we look at about 25 sectors and subsectors. Each of these, it really works differently during parts of the property cycle, covering everything from industrial, which has been incredibly hot for many years at the moment, retail, the different types of retail, all the way through to lodging, gaming, healthcare, self-storage, cell towers, fiber optic networks, data centers. And what for us over many years was something that we've always highlighted, but sort of fell by the wayside for a few years, except now has become even more of a hot sector, and at times is keeping up with the Bitcoin memes, which is the resources side on timber especially. So it's a very deep asset class and a lot broader than just offices and retail. Also, when we're looking at the new non-traditional sectors, is what we've seen is a massive increase in their representation, market cap-wise, across the investable universe. So if you go back 20 years, you'd see, looking at towers, timber, data centers, a really small percentage. All of those adding up to about 35, 20 years ago, now actually constituting more of the market cap. In global sectors, which has been fabulous for us because these are sectors that we've focused quite heavily on since the formation of Ridgeway Global. Also looking at the last 10 years is what really has been performing the best. So this would be US data. And if you have a look, you'll see very seldom do we really see any of the old ones coming through, retail coming through once or twice, but the bulk of the top performers really coming through industrial, lodging resorts, manufactured housing, which will be prefabricated, as well as trailer type houses in the US, which have been a extremely strong performer over the last 5 years, especially coming through again 2019. Last year, data centers, unsurprisingly, just really having an exceptionally strong year, especially the first half. Not surprising, when we consider the impacts of lockdown and just the way we're doing this today, being forced to do it through Zoom. This is going through data centers globally. It's something that we can't get away from. Having a look at the sectors, how they've performed last year and this year as well. Obviously, last year is, if we have a look at retail and diversified, which would be companies that hold various asset classes inside them, actually had a very good start to the year. We had some interesting corporate action, Simon, by Taubman, everything looking good. And then, along comes COVID, and here we go, and we have the crash that came through, and the very strong lockdown there, the effects of lockdown there that came through and really impacted everyone quite heavily. And then having a look at the impact we had with the specialized, which for us would be data centers and towers, and also the industrial index as well. Very strong demand coming through for logistics and warehousing. But as the year started to go through, as Evan showed a little bit earlier, as you had people starting to return to some of them a little bit more traditional and heavily beaten down sectors, as you saw a slow dip down of logistics and warehouses and data centers, and an interest coming through in retail as well. But retail had quite a few false starts to the year, pretty much until we get to that November the 9th vaccine announcement, where you just had a huge amount of positivity returning to the markets. It's really continued very much in a similar vein this year. I'd say for the first month and a bit, it was a little bit sideways as well for most of the sectors. But then as we started going through into February, March, and April, we've had very strong performance coming through retail. As things have started to reopen, people have become a lot more positive. But also, as we've seen with a lot of the results that have come through from Q1, the logistics and warehousing sector globally continues to perform extremely strongly. Demand is extremely robust. Reversions are very positive. It really has continued to actually perform very, very well, and very nice bounce there. Obviously, this is just the end of last month. But the important thing is to have a look at the performance of the sectors from the start of really the COVID's impacts, as we refer to it up to now, which would really be the start of last year up to the end of last month, where this runs to. And while we can see we've had these very positive bounces in retail, is, when we look at it on an index basis, in general, the sector is still trying to get back to where it was. The same with office. But we've really just seen this continued very strong performance over the period from the logistics and warehousing, as well as data centers and towers. And these nice pickups coming through at the end of last month, off very strong reporting of those companies too. Our views really on the sectors, we've just chosen a couple of sectors here. Obviously, I'm not going to inflict 25 sectors and subsectors on you, but we're just looking at the main ones here. So retail, we've started to see it improving. It's been a positive to see. Average occupancy is slightly down from highs, obviously, but not as bad as I think as people would generally assume it to be. I think when people think with the retail collapses and the lockdown, that you would be looking at occupancies below 90%. On average, we just really haven't seen that. But where we get concerned with retail is really looking forward is growth is an issue for us. Yields aren't actually too bad. Of course, the problem with averages is they show and hide a lot. Also, there are quite a few very large global retail REITs that actually have suspended their distributions for anywhere between 1 year to 3 years. Obviously, we'll have to see how things pan out as to whether they actually keep those distributions bottled up for the next 3 years. The discount to NAV has narrowed a bit, obviously far better than it was last year at this particular time. So when we look at it, we see in the short term, we're seeing more positivity to the sector. But when we look forward, we are still seeing challenges to it. There's a lot of space that is vacant that needs to be filled. A lot of retailers that actually went bankrupt over the time period, especially large anchors in parts of US malls. and a very big divergence, I think, going back to similar experiences to what Evan mentioned in the South African sense, where in general, people have avoided large enclosed malls and they've really moved into towards the more open air, the more convenience type retailing. It's very much a global phenomena as well. So if we look globally, we're not really seeing any markets where we are getting massively excited that the outlook, both for rental growth and occupancy going forward on a one-year basis, is something that really excites us. And I'll say we're still seeing it lagging the index performance-wise over the period. But if we have to choose, our favorite sectors within the sector at the moment would be the strip centers and US-based strip centers. Then moving on to industrial, it's still a sector that we are very positive on and have been positive on for several years and remain positive on going forward. You've started to see the weightings within the indices start to pick up a little for logistics and warehousing in particular, but actually still quite low when you consider the impact that they have had over the past few years. Occupancy numbers are very good. Growth is positive. The yields are a bit lower on this, but again, we're not too concerned by that. We are total return investors. And we're very happy with the total returns we've been receiving from the sector. The premier to NAV, averages, as I mentioned earlier, can be hiding a lot. We have within the universe that we look at, we actually do have some companies that are trading at 100% premier to NAVs. Some of those we think are a little bit overdone. Also, some of the way the calculations are done, it can also hide that because of developmental activity within it. But we still see very strong short-term growth for the sector, and also looking at long term. If we are slightly concerned, we do know that eventually the supply-demand balance will eventually start to change a little bit. There's a lot of developments happening while they're being taken up at the moment. Obviously, going forward 3 to 5 years, is we don't think that can continue. So we have to watch that very carefully just to make sure that we are not caught on the wrong side of that. But in general, rental growth across all the markets that we look at are positive. Occupancy is quite stable in this. We've seen growth in a few markets as well that are looking pretty good. And while you might say, why is occupancy quite flat, as you'll see quite often in these markets, is you'll have tenants moving from older facilities to newer, more efficient facilities. So you're not really having a massive change in occupancy numbers, but when you're looking at what they're prepared to pay rent-wise, those actually are a lot more positive. Again, very strong performance versus the index, which we've been very happy about. And then if we look at where we're seeing the strongest performance, we are obviously on the logistics and warehousing side, not manufacturing, industrial. And then it would be in Europe, in particular Eastern Europe, we're seeing very strong performance there. Residential, another market we think we probably expected to perform a little bit better last year. It's been having a very strong performance as we start to come out of COVID. We're seeing a very high levels of demand, especially in the US, Australia, the UK. Occupancy levels are extremely good. Growth is, I'd say we're comfortable with it. Again, some markets are obviously seeing much higher growth on average. Yields we're comfortable with. Premiums to NAV are not out of line. Growth short-term and long-term, we're seeing it remaining robust and positive going forward in all the markets really, except China, which we're always a little bit concerned as to how accurate the statistics are we have coming from there. We're seeing rental growth and occupancy remaining very positive. I think if any of you have tracked house prices within, especially Australia, Canada, and the US over the past 6 months, it's just been quite phenomenal what prices have been doing. And that really is a support to the rental market. And that's why if we look at markets that we remain the most positive on would be the SFR market, which would be single family rentals. So those are individual houses for rent, and the bulk of that would be in the US market, which has performed very well within that. Office, again, very similar to what Evan was saying. There's just, in a global sense, there's a lot of noise around the sector. People just are not sure where we're going to end up coming out. In office, post the crisis, we don't think the offices are going to be disappearing, but just with the amount of noise in it, the power dynamic really has shifted from the landlords to tenants. We're just not sure of the demand coming through. The reversions globally are not great. We're not seeing growth. if we have to choose a market, we would say we would probably be most positive on the life science markets, and those again primarily in the US, and not really a surprise considering the amount of life science work occurring around COVID and biotech. Data centers and towers, again, even though I think a little bit of invested appetite dropped off last year as people tried to switch back into retail to try and catch bounces, is we still remain very positive on this. We are not seeing a change in demand for data going forward. We're still seeing it as remaining very robust. We're very comfortable with where we see this ending up going forward. Again, positive on all our markets looking forward. And again, if we're looking at where our highest conviction is at the moment, is really around data centers and Chinese-focused data centers at the moment. They've had a bit of a horrible year, beaten down a bit, and we think there's quite substantial value within those markets at the moment. Obviously, interest rates and yields are something that comes up all the time. Real estate doesn't escape this. There's a general assumption that real estate is a bond proxy. We don't ascribe to that. Property is not a bond. It's not how it functions. It does get caught up whenever these things happen and move. We track this data going back to 1976, where, of course, I'm sure most of you were definitely not born yet. I unfortunately was. That's why I have no hair. But what we have a look and we typically see is that whenever bond yields are increasing, is we do see a sell-off in REITs typically what happens, and they will generally underperform equities. But what we see post that is 180 days, a year past that, is we start to see very strong performance coming back from REITs. They do perform quite well. Obviously, you know, going back to 76, if you're looking at very high inflation and even stagflation, is actually see that listed property performed extremely well. And what we've seen over the past few years as well is even with the sell-offs as yields start to move up, it's actually calmed down a lot more than we used to see in previous time periods. And then we have typically on the last periods where we've got the 180 days, which obviously for the current period we don't have, we're still waiting for that, is we have seen that strong performance. And why are you seeing the strong performance? You know, for us, it's property companies are part of the real economy. So when economies are moving up, they're getting better, where there's inflation, it's typically good. There's economic growth happening. This eventually translates into opportunities for property companies. Obviously, different companies react differently to parts of the economic cycle. They react differently to the way interest rates can move as well. But as I mentioned, with 25 sectors and subsectors, there is a sector for every part of the cycle that you can find. Also, the lease terms affected quite significantly as well. But at the end of the day, these are real businesses. And when the economy is performing well, they perform well. And we're starting to see that coming through. The economies are starting to stabilize, starting to normalize. And as you know, it's not just South African REITs that have had a very good start to the years. We've seen the same globally too, obviously, which we're very happy about too. Our performance with our focus, we have a very strong focus on choosing sectors going forward. So going back to the start of last year, we've been extremely happy with the way that our fund has performed. We've performed extremely well versus our peers and the index. Very happy with that performance, and obviously that's something that we work pretty hard on keeping going forward. I'll skip that. So our outlook for the year, we really are we're not seeing volatility as going away. The narrative has started to obviously improve as vaccines have started to come through. The UK and the US is doing extremely well. Europe lagging a little bit, but they're getting better every month, so that's obviously great. And with summer coming there, we do think things will start to turn around very quickly. Africa close to zero, but I think that the change we've had here last week is obviously very positive, and we're very happy with that. But the bulk of the world is still very slow, and unfortunately, definitely parts of Asia too, we're not seeing as much as we would have liked to. Global growth we still see as being under pressure. There's still noise from the views on rates and inflation outlook, but our outlook is a little bit more that the impacts on those will be a bit more benign than what I think general participants might be seeing. But the important thing to remember is not all sectors within the listed property space will perform the same, and it's really where quality and the sector really does matter. And if we look forward, we still remain very positive on data centers and towers, logistics and warehousing, and then on the residential side, primarily on single family and manufactured housing. And that's my time. Thank you very much, and look forward to questions.
Yeah, thank you. We've got a moment for questions because we have run over a little bit. Claude Harvey's question, I think, is the most valuable here. Just the one question, I'll ask it to you, Gareth, and then move on. My view, says Claude, is the average occupancy is likely higher than expected due to existing rental contracts in effect. Will this decrease as leases start expiring? And I guess that goes across every sector, across the entire globe. How worried are you about leases?
We're not really, again, it really depends on sectors. So office-wise, I would say we're concerned on the office market, that we would expect to see a decline on those, especially in the short term. Longer term, it should stabilize. Retail, it will be very similar. When it comes to data centers, it's not something that's concerning us. Logistics and warehousing, especially not, we're actually still seeing those as being pretty positive. When we're seeing it on residential, again, not concerning us. So it's very, very sector specific. But it's really the ones that concern us still going forward would be retail and office.
Bruce, can I step in for one moment there? There's something that the old Into Liberty International once upon a time used to disclose: voids versus vacancies. Vacancies when you got no tenants. Voids is when you got a tenant, but you know they're no real tenants, so you're not even collecting rentals out of them. So the person asking the question is 100% correct. There's a lot of superficial or grey occupancies where there's sublets, people are just keeping the space and not actually paying. So, you know, in certain sectors, he's 100% right. It's artificially high, the occupancy levels.
Got you. Thank you very much indeed. Right, guys, please join our property experts in their room at about 1:30 this afternoon, and they will answer your questions more specifically. We do need to move on, I'm afraid, to Richard Pitt and James Bullock, who are going to be herded and corralled by Florella Yates. Florella is with Momentum Investment Consulting. She's a DFM and is going to be talking all about global equity views with our two panelists this afternoon. Florella, over to you.
Good morning. Thank you for the introduction, Bruce. As you correctly said, we are a discretionary fund manager based in South Africa with a small team based in the UK, and we partner mainly with Category 1 and 2 advisors to offer a range of portfolios from bespoke solutions to off-the-shelf solutions for investors. And it's my absolute honor to be hosting the Global Equity panel this morning. As most of you know, one of the biggest concerns currently preoccupying investors is rising inflation. And this has coincided with the rotation out of quality and momentum into value. Another theme that we've seen is headline market returns have been increasingly driven by the largest mega cap FANG stocks in recent years. And the recent style shift in markets has caused some weakness in these names, which I think creates an excellent opportunity for active managers to outperform some of the larger index funds. So here to share their thoughts on what is driving global equity markets and how they are positioning their portfolios for the current environment, while still maintaining a focus on long-term value creation and delivery of performance for investors, are Richard Pitt from Blue Alpha and James Bullock from Lindsell Train. I don't think either of them need an introduction, so I'm going to hand over to them to talk through their philosophy. Please can I remind you to continue posting questions in the Q&A function, and also if we don't get through all of them, we will address them in the breakaway rooms. Thank you.
Well, thanks, Florella. Thanks, everybody. And Richard, back to you soon. It's very nice to see you all. It's very nice to get this opportunity to speak to you. I'm just going to buzz through one quick disclaimer, and then I've got one org chart as well that I'm not going to dwell on, but I think just suffice to say, I'm from Lindsell Train. We're a UK-based investment manager, founded 20 years ago in London. And we remain a founder-owned company. We've got a small team and some straightforward, but hopefully well-aligned business principles that you can see in the bottom left. I've got one more quick slide just on the investment principles, just to kind of prep you before the main bit of the talk. So again, I'm not going to read through. I just want to get this idea across that we are running a very long-term strategic approach. We're looking to own great cash generative businesses, buy them for less than intrinsically worth, and then own them pretty much forever. And we do this via just 3 country-specific strategies. We've also got our flagship global equity fund, which as of March now has a 10-year track record, and that's what I'm going to talk to you about today. So if we move on to really the meat of the talk, with the headline, if you want different performance, then you have to invest differently. That's a classic quote from Sir John Templeton. It might sound like a bit of a statement of the obvious, but I also think it's a pretty good signpost for what we're trying to do here at Lindsay Train. We are not particularly enamored, let's say, with the average business, nor with the average rates of return, internal rates of return they typically achieve, or by extension, with the average shareholder returns that this translates into. We're instead looking for those rare and, as I say, great businesses that have staying power, that have the ability to earn significantly above average rates of return for very long periods of time. I think if you look at this slide, it's fair to say that over the past decade, we've both achieved different performance and done this by investing differently. So for a start, you can see that our global fund is very highly concentrated. We own just 24 companies versus the 1,500 or so that populate the global index. Secondly, our sector weighting, as you can hopefully see from the dials, skews really very differently. And then finally, just look along the bottom there, and you can see that over these last 10 years, our turnover has averaged at a pretty glacial 3% per annum. So why are we investing in this way? Well, in short, the world, as I think we've all seen over the past 18, 20 months, really is a horribly unpredictable place. We think that really at any level, from macro to micro, trying to predict what's coming next with any level of certainty is close to impossible. We didn't see COVID coming. We weren't predicting Trump or say the financial crisis before that. And if you then zoom in and think about on the micro level, think about the disruption that's been brought by businesses like Tesla or Apple or Amazon to industries like auto, telecoms, and retail. All of this raises the question. As investors, how do we deal with this? I think the only answer that we know of is to really focus on the long term, to take the view that the immediate future is inherently unpredictable, but that over kind of longer, multi-year, even multi-decade time horizons, there are actually some basic workable assumptions that can be made. And I think this really explains our low turnover. It's us wanting to invest on the time horizons that make sense to us as well. But sadly, I think not every company warrants a long-term holding period. And we have a next chart here, which comes from a consultancy project that basically set out to see, for how long does the average company really persevere? And they weren't looking at startups, they were looking at big US listed corporations. And they found that today, the average company can be expected to remain on the S&P 500 for actually no more than 15 to 20 years. Basically, most companies simply don't survive all that long. And you've got on the right a quote from Larry Ellison as well, of Oracle fame, putting it slightly more emotively, pointing out that whilst some things in the world do last for hundreds of years, companies on balance don't. And I'm afraid to say he is essentially right. So the upshot is that if you're going to have a low turnover approach as we do, then concentration is critical. There just aren't that many great durable businesses out there to invest in. So where do we find them? How do we arrive at the sort of the skewed sector weightings that I showed you back on the previous slide, i.e. a portfolio that is comparatively low on tech and high on things like consumer brands, things like marketplaces, things like media companies? Well, one thing we really like to do is to look back at the history of the company, look back at its heritage, and knowing if we can see a business, if we can know that it's survived through the disruptive decades that have already passed, that it's already proven itself, then that for us is a really big comfort. We see it as direct empirical evidence that we have on our hands a so far successful and already robust business model. And so this kind of leads us to this prejudice we have for businesses and for sectors where we can identify really, really long track records of high returns, of wide margins, where we can see this like really strong value, long-term value creation from underlying compounding. But unfortunately, you only find this in a few places. And you find it in places like premium branded consumer franchises, where you've had companies and brands that have been invested in through decades of advertising. You find it with really high quality intellectual property that's been similarly nurtured over long periods of time. And these are all things that are really difficult to replicate. They're easy to monetize, they build genuinely high barriers to entry, and all of this creates deep moats around these companies. Now, if you think about things like technology, that's actually quite different. It's actually not one of the sectors we spend a lot of time looking in. And that might seem odd, given how successful the area has been over the past few years. We've had, obviously, if you think back, you've had the rise of the FANGs. You've had then this massive COVID-driven shift to digital that we've seen in 2020 in particular. And you've now ended up with the MSCI World Index very heavily reliant on tech stocks. So the top 7 entries in the MSCI are all from this sector, and these 7 companies alone contribute almost 15% of the entire index's market cap. Okay, so fair enough, but we just don't have the same level of comfort investing in, say, a young disruptive tech company that we might with a heritage-rich, well-established consumer staples franchise. How will technology have changed over our investment time horizons of, say, the next 20 or 30 years? You know, think how the world looked just 20 or 30 years ago. We had no smartphones then, we had no Facebook, we had no Google. In fact, we barely even had the internet 30 years ago. What will the next couple of decades bring? You know, what new competitors will have risen up to exploit any new technologies? And so if you put it another way, if you were to invest with a long-term concentrated approach, how comfortable would you feel with a set of businesses that are not yet even as old as your planned then holding period? Would you really want to entrust generational inheritance, say, to these types of companies? And actually, frankly, how many multi-generational tech companies can you even think of? The turnover and the churn in that sector really is just too high. But on the other hand, if you look at the consumer space, actually, there are quite a few really venerable family-controlled companies, and we own several of them. So if you take the Dutch brewer Heineken, for example, one of our holdings, this was founded by the family in the 1860s. 4 generations on, it's still owned by them and us as co-investors today. And for the last century and a half, you've got a company where the Heineken family have been building their brands, they've been expanding distribution, they've been earning fantastic returns to their equity along the way. And this has more than paid off. The current owner, Charlene, who's the great-granddaughter of the founder, is today the richest person in the Netherlands. Now, none of this means that we know what each year will hold for Heineken, nor the family. And to be honest, looking back over the past year or two, COVID lockdowns have been particularly difficult for them, with bar closures all around the world. But it does mean that we can take a view as to whether people will still be drinking beer in 20 years' time, you know, as a sort of gross statement. That there might actually be part of the world where people are drinking more beer. And then, as importantly, whether the company's brands, many of which have already been dominant for generations, will still retain their relevance within this overall market. Now, it doesn't mean that these are easy questions to answer, but I'm not sure they're impossible. So here then are our sort of headline heritage stats for the fund. Remember back a couple of slides, we saw that the typical listed company is probably expected to survive less than 20 years. We have a collection of businesses here that have an average age approaching 120 years. So, you know, these are old companies. Topping that, our oldest stock in the portfolio is the London Stock Exchange, which was founded as a business way back in the 17th century and is now, well, over 300 years old, 350 years old. And interestingly, we can actually use a company like the LSE as a case study to show that actually not only can you mediate the very long-term risks with these really rare heritage-rich companies, but you can actually also end up generating actually impressively tech-like returns from them as well, even over kind of slightly shorter time horizons. So the LSE, it's a trading venue, it's a marketplace, it's operating a very, very old business model. It's attracting, essentially you attract traders to your venue, you develop a dominant exchange where customers come because other customers are already there. And then you, over the centuries, you build this fantastic moat around this provision of liquidity. It means that they're now, 350 years on in an almost monopolistic position where they, for example, own 90% of the global market for swap clearing, for specific dynamic. And if you're a new entrant into that kind of a market, that would be, and has already proven to be, very, very hard to disrupt. So slightly for fun, but I thought we'd compare this stuffy old business, LSE, with two of the best known banks. So we've got Facebook and Google on screen, obviously two relatively young dynamic companies, 300 years LSE's junior, and see how all of them have done over the last 10 years, i.e. the period of time over which we've been running the global fund, over which we've owned LSE within it. And I think you can see from this chart that actually, plus the old LSE has not done too badly. It's chalked up a more than 10-fold total return for its shareholders, for our clients. And that actually compares rather favorably even with Facebook and Google, both of course being two of the more successful examples of tech companies in recent times. So you've got a business, the LSE, which since listing has built from a very stable base, making very good capital allocation decisions. It's been bringing in-house lots of data, trading assets. It's doing this, it's significantly expanded on the monetization potential of the venues that it has. And this in turn has very clearly been reflected in the share price performance. But importantly, it's been able to do all this safe in the knowledge that at its core, there is something very, very solid, something very, very hard to disintermediate. Now, I'm obviously not trying to say that tech is going away, that it's not important, and every business, even stable ones, will be impacted by the ongoing revolution that we've got in technology. But companies like LSE, like Heineken, we don't think they're facing existential threats as a result. Not in the same way that a tech company might once a new iPhone, smartphone, or say algorithm becomes available and completely kind of disintermediates, obviates its raison d'etre. Our companies, we think they've got time to react, to adapt, actually to make their businesses better by using other people's technology to improve, say, their distribution channels, say their use of data. And so this is sort of taking me to my final point, which is that actually heritage isn't just evidence of a strong business model, it's actually a critical way to defend it once established, i.e. it becomes really self-reinforcing. And in certain sectors, for certain brands and assets, actually heritage becomes a moat in and of itself. Now, Heineken's 150 years of building and investing in its brand has created, we think, a level of consumer loyalty or kind of global recognition and resonance that really can't be recreated from scratch. The LSE, on the other hand, you've got reputation, you've got prestige as a trading and a listings venue. That's really important. That's a really big part of its irreplaceable appeal. And so finally, we've got a last example from us of a particularly esoteric sector into which we like to specialize, and that's sports franchises. And we've been investing in sports franchises successfully, actually for over a decade. We now own 2 football clubs in our global strategy. We own Celtic and Juventus. We own 1 Manchester United, you can see on screen, in our UK fund. In each case, we are the largest shareholders outside the family. And I think it's fair to say that these are definitely not tech companies. But over generations, and it has been generations, they have been very serious beneficiaries of other people's technology. So thanks to things like, in fact, the development of cable TV, then the internet and video on demand, and you've got smartphones, you've got YouTube. It's basically more channels, it's more ways for more people than ever to access their product, which is the video of their live games. And the consequences, the value of this sort of really differentiated content has risen exponentially as a result. All 3 of these clubs were founded way back in the 19th century. Each has won the European Championship. They've won at least 20 domestic titles. They've been doing so, and they've been building a global fan base, which actually represents customers who are more loyal probably than those of any tech company, perhaps even of any company full stop. You've got fans here that are with the team, with the company, in large part because of the club's history, in large part because of its heritage, a very, very long track record, and all that stands for. And this, we think, is genuinely irreplaceable. And as business modes go, actually, I think it's a pretty good one. So that's it for me. Thank you very much, everyone, for listening. I think, am I handing back to you, Fabella?
Yes, thank you so much, James. We've got a couple of questions coming through, which we'll address after Richard is done. But thank you for that. Please carry on posting questions for both speakers. Richard, are you ready to hand over to you, or should I carry on with a couple of questions?
Right, hi. Sorry, guys, back again. Apologize for all the gymnastics there.
That's okay. We can.
I think we are going to stand out as Exhibit A as to why we need to get back to seeing each other face to face, because you know, people like me battle with the tech. Okay, and unfortunately, you also have to look at my face from a fairly unpleasant angle. All right. Okay, so here we were at the panorama of risk slide. I've spoken about money supply and what are the consequences been of this enormous stimulus. We know that markets have risen a lot. Valuations are certainly very high versus history. If we look at something like, I mean, PEs are simple enough, but if we look at global EV to EBITDA levels, the median number is way above average versus history. So that's quite concerning. We've seen a lot of speculative behavior. And if you look at something like Bitcoin versus other bubbles through time, and admittedly, there's probably some poetic license in terms of when you pick the beginning of the bubble, and Bitcoin is surely much smaller in size versus things like the tech bubble, the US housing bubble, but nonetheless, it makes the other bubbles pale in insignificance. So you can see the appetite for risk is very high. And this has also been exhibited with something like the non-profitable tech index, which through last year rallied 3 or 4 times, has now come off a bit. And similarly, the huge growth in SPAC, special purpose acquisition vehicles, basically raising money with totally unspecified plans as to what they might do with that money. And then on the far right bottom, we have US CPI, which has just recently printed above 4%. And so a big concern is we have high valuations, lots of money supply, lots of sort of speculative behavior, and a sense that surely inflation is going to rise. And with that, what will the impact be in terms of interest rate policy and Fed support, and how does this affect markets going forward? So the two big consensus views that kind of everyone seems to agree on at the moment, in investors and fund managers, is that there's going to be a lot more inflation going forward, and linked to that, that value will beat growth. And the kind of thinking behind this is very simple. In a reflationary environment, growth is far easier to come by, and so even businesses that are not don't have that much growth can grow quite easily, and you're buying them cheaper as value stocks, and the premium that you pay for growth is no longer necessary. And I guess the other side of the coin is if you think that interest rates are going to rise because of inflation, the impact that has on longer duration assets, and growth stocks are essentially long duration assets at a mathematical level. So is the great reversal beginning between value and growth? And here we very simplistically track the Russell Value Index versus the Russell Growth Index. And you can see there are green shoots for value investors, if you will. And this started, this kind of relative performance of value over growth began in early November, marked explicitly, I guess, with the knowledge that we finally had some viable alternatives on the vaccination front, and that as we vaccinated, there'd be a return to normal. And of course, many of the bombed out cheap companies are highly cyclical and geared to a normalization of the economic environment. If you unpack this a little bit further, and here we've just looked at the sector performance within the S&P, the various sectors relative to the S&P, and we can see there's really just 3 lines that I want to focus on. The one is the dark blue line, the top line, which is the energy sector. Below that is financials. And then the red line is the technology sector. And you can see very clearly another way to explain the rotation from growth to value is a rotation towards energy and financials, both of which make up a large part of the value sector. Energy, of course, comes off a very low base. We all know the story about oil and how that impacted the energy complex last year. And financials, of course, stand to benefit if there's a view that interest rates are going to rise. And counter to that, technology, which really was the poster child of success during the COVID lockdown environment, has underperformed in this period. So I think it's kind of less obvious that it's a value versus growth story that's playing out. You can explain it very clearly through sectors, and perhaps food for thought is if you think about financials and energy, they kind of stand out as two obvious sectors that are at risk of disruption going forward, and disruption specifically from technology. So not such a straightforward story. The other point to make is that value is becoming harder and harder to discern. And if you, there are many ways to measure value, but if you look at it on a very simplistic basis, price to book, for example, what you see is that there are many sectors with lots of intangible assets. So the best example would be to compare a company like ExxonMobil, the petrochemical giant, with something like Facebook, social media company. Now, both companies spend they invest very similar amounts of capital each year. ExxonMobil puts all of it onto its book, so it increases its book value. Facebook expenses about half of what it invests every year because it falls under research and development. Now, we would argue that this research and development in time will prove to be highly valuable and cash generative, but it doesn't obviously sit on the balance sheet. And so it distorts relative valuations between old companies, which have lots of capex and build up their balance sheets, and new companies, which not only expense a lot of investment, which is capex in nature, but they also amortize, what they do put on their balance sheet, they amortize faster. And this chart really just shows that if you adjust for intangibles, sectors like consumer discretionary, consumer staples, and then especially IT look a lot cheaper than what they first appear. So value is not always as obvious as it seems, and it's becoming more and more complex to discern value. Now, what's happened in the last year is really it's been a story of risk, which has outperformed both quality and profitability. On the top left-hand side, we track a pure volatility index against a pure profitability index. And you can see, as you might expect, and in this case, volatility is a proxy for risk. The profitability index did exceptionally well going into COVID and the beginning of the lockdown. And as markets started recovering, the volatility index or risk index, started doing extremely well. And in fact, profitability as a characteristic, if you will, was kind of like an impediment to investment performance in a portfolio. Looked at another way on the bottom right, we're looking at global quality versus global risk. And quality in a very simple sense would be companies with strong balance sheets, high cash generation, high margins, good returns on invested capital. And global risk, kind of the opposite of that, weak balance sheets, low margins and poor returns. And you can see very clearly that the last year has really all been about risk. That's been the best way to make money in the markets. So what is the risk reward of risk at the moment? On a valuation basis, quality versus risk at a price to book relative is kind of about average. So nothing much in that. But if you think about the potential risk in the markets, or if you're concerned about risk in the markets, whether it be a possible taper tantrum, as the Fed reduces its support for markets, whether it be high inflation and what impact that might have on rising rates, or just old-fashioned valuation. If you think there's a chance that markets could potentially be softer going forward, then clearly global risk is not the place to be. And global quality is a good place to be. What this chart shows is that in rising markets, global risk does very well and global quality relatively underperforms a little. But in falling markets, quality outperforms by a lot and risk does very badly. So I think that's easy enough. We can say risk has been kind of like drinking out of the punch bowl of the party. We don't want to be there. So what about value? What about value versus quality? And here we look at the last three crises, the tech bubble, global financial crisis, and coronavirus. And we just track peak to trough drawdowns in each instance. And then we show the cheapest stocks on a price to book basis. So that would be the bottom quartile of stocks, price to book, compared to the highest quality stocks. And that would be the top quartile on a sort of return on invested capital or cash flow return on invested capital basis. And what you can see is that quality has beaten cheapness in every instance. And in fact, only in one instance, which was the sort of unwinding of the tech bubble, did cheap stocks relatively outperform the market. In other instances, they actually underperformed. I'm not sure if the numbers are clear here, but what we're trying to show is relative to the index level. So that's where you need to compare the numbers. And I think the reason for that is as the tech bubble built up, there were a lot of very high quality companies that started floating around in the value space. So these companies were high quality, but they were also very, very cheap. And when the tide turned, they benefited from that in comparison to, say, the global financial crisis and coronavirus, where cheap stocks did poorly because there was not a lot of quality sitting within those categories. You can also look at this on a sector neutral basis, and it tells you the same thing. It just moderates the numbers a little bit. But the point is, I think if you are concerned about the market going forward, then it's easy to say, I want to hide in value. We would say there's a better argument to hide in quality. And if you can get some value in quality, even better. If we look at the alternatives now, in terms of risk tilts across value, growth, risk, momentum, and then quality, and what are their characteristics, a few interesting points to make. For the first time in a long time, value has a relatively attractive return on equity. And we think the reason for that is that explicitly because a lot of quality stocks are starting to drift into the value bucket. Growth is looking expensive with quite low profit margins, which suggests that growth is, there's a lot of hyper growth, high valuation. The kind of returns are still a long way in the distance. And then risk and momentum look like very similar styles at this point of view. There's risk has done very well, so by definition it has a lot of momentum. Or if you just screen on momentum, you'll pick up a lot of risk, and you can see very low profit margins and also low returns on equity. Quality obviously is more expensive than the market, but much higher returns and much stronger profit margins. So the opportunity for us is to still, we focused on quality, but to try and find cheaper, less expensive stocks within the quality bucket. And invariably you have to pay up, but you don't have to pay up too much. And then also find those companies that are sort of hovering around in the value space that are quality companies. And this is kind of the opportunity that we see going forward, is that there's a lot of discarded quality, ignored quality, kind of masquerading as value, if you will. And a lot of these companies are in plain sight. I mean, they're not hiding away. They're not special situations. They're well-known businesses. They've been around for a long time. Intel, all the viewers will know these companies. Semiconductor business. AbbVie, the owner of Botox. The good news about Botox is vanity is not going out of fashion. Facebook, the business we all love to hate. The defense company Lockheed, a very high return business over a long period of time. NVR, a home builder in the US, owns Ryan Homes, also very steady compounder, very high returns, generates lots of cash, buys back its shares every year. The financial services and advisory business, T. Rowe Price, and then pharmaceutical business, Roche. So, you know, this group of companies, and we have many more like this, they're well known, they're large, they have mostly have long track records. They generate high to very high returns on invested capital. And then the valuations are kind of modest to neutral. I say Facebook is, the valuation is kind of the same as the market, but it's a much better business than the market average itself. And then, you know, all of these businesses we think have kind of modest to reasonable growth going forward. And a lot of them pay healthy dividends. In the case of AbbVie, you get a 5% dividend. So we think this is an interesting space, kind of hiding in plain sight. And just a final comment, I'm about to wrap up, the question of what is value. And people always, you know, we all want to buy cheap assets. I mean, that makes perfect sense. But at the same time, when you buy cheap, you often get what you pay for. And I think this graph is food for thought. You know, there's been a long-term shift in the return on invested company of businesses, and maybe it speaks to technology, the network effect, a winner-takes-all economy. But this is not a short cyclical event that's happened. This has been, you know, building up over 30, 40 years. And we think it's likely to persist. And the way for us to extract value is to invest in companies that have these high returns. So I will end with a very unoriginal quote from Warren Buffett, the master of value investing. And I think, you know, he's a great example of someone who, by his own admission, when Charlie Munger finally got him to pay up for businesses, pay up for good businesses instead of always trying to find a bargain, that's when, you know, that was like a real pivot point in terms of his investment success. Thank you.
Thank you. I'm conscious that we're about 7 minutes over our time limit. So if I can please ask you to join us in the breakaway room where we'll answer a lot of the questions coming through. I have quite a few of my own. But thank you to both of you. And please join us. Just if you watch the chat function, you'll see the link to get into the breakaway room. Great insights from both our speakers, and I'd like to hand back to Bruce, please.
Thank you, James. Thank you, Richard. Thank you very much indeed. Yeah, the breakaway rooms, those details in the chat box over there. You'll be able to get to those chat rooms in just a little while, in the next 45 minutes or so. On to our penultimate session this morning, Roger Williams and Tony Bell. Roger is with Centaur Asset Management. And Tony Bell with Vunani Fund Managers, looking at local and global multi-asset flexible investment styles. I think, Roger Williams, you can go first.
Hello? Which one is it? Hi, is that the right screen?
Okay, Roger, we can see your PowerPoint window. Do you want to click on slideshow from beginning?
That's on the other screen. I'm just trying to move it. Okay, just hang on a sec.
If you've got it in slideshow mode on your other monitor, then okay, now we're seeing your presenter view. You can go to the top left where it says display settings.
Yes.
Right of that and swap.
Is that correct?
Bingo.
Perfect. Well, thank you very much for giving me the opportunity to present. I'm going to talk about how you can use macro asset tilts to improve the risk-reward ratio on a portfolio. Just to quickly start to introduce Centaur. Centaur has been going for over 20 years. With a clear vision to be the best retail asset manager in South Africa. And our intention to do that on founding was 3 key principles: to deliver investment excellence, outstanding service, and utmost integrity. I think if we deliver on those, I think we'll be one of the best retail asset managers in the country. We're particularly proud of our long-term track record. We've managed to achieve returns just under 20% on the right-hand side, outperforming our benchmark by 8% per annum. That's on a net basis. So very strong returns since inception, and we've continued to outperform relative to our benchmark for many years. Just going into the presentation. To start off, we're just going to introduce you to the efficient frontier. Most of you will know this. The efficient frontier really provides a guide to invest at the optimal asset allocation to achieve an investment outcome with the lowest risk. So on the right, I've created an efficient frontier for South Africa using observed variables. So for example, cash, we've put in an estimated prospective return of 4.5%. We've used the All Bond Yield Index at around 9% as a reference for bond returns. We've added a 4% equity risk premium to get a 13% return for SA equities. And our estimates for offshore equities are slightly lower. We think they are at a very high level, so one needs to be slightly more cautious. And that's a 12% return. Putting this all together, looking back 9 years, we've created the efficient frontier, which is the green line. So those are the optimal asset allocations to give the lowest return for desired expected return. You can see the Centaur Balance Fund, which you can see on the left what the weightings are. That's just almost on the efficient frontier. We did construct this over 5 years ago, so it's good to see that it's still very close to the efficient frontier. Now, the starting point for creating a portfolio is the efficient frontier for a financial advisor, and we get recommended asset allocations. But the question is, can we improve our returns via asset allocation? And I think consensus is that says no, but I think we've uncovered some very powerful indicators which guide their direction, and by tweaking your asset allocation, you can improve things somewhat. We'll give you some pointers towards this in later slides. Just to give you an idea how efficient the Centaur benchmark is, we've looked at the returns of this benchmark over the last 10 years. That's the red line. It's up around 10% per annum, and that's outperformed the category average by about 2% per annum. So it's managed to consistently outperform the average. And if we can beat our benchmark, we should be one of the best performing funds in the country. I think if you look since inception, we are a top 10 performer, and that really shows that the strategy is delivering. Now, what would guide us on asset allocation? I think we monitor spreads across asset classes to guide our asset allocation. So just using the bond index as an example, cash is currently yielding about 4.5% in the money market fund. The All Bond Index is 9.2%. So the spread between those is 4.7%, just deducting the one from the other. The modified duration, which is observable on the All Bond Index, is 6.3. And you can work out that bond yields, the All Bond Index yield, must increase 75 basis points to underperform cash. So if the All Bond Index doesn't derate or re-rate, you'll earn the spread of 4.7%. We think this is attractive, but one must not ignore the fundamentals. Fundamentals are equally important. So just looking at some of the fundamentals, I think South Africa is in a poor fiscal position, and that's really why the yield is so good. But having said that, tax revenues are being boosted by an unbelievable resource boom, so that's extremely positive for the fiscus. And also the recovering economies also boosting tax revenue. So maybe expectations may be a bit too negative on the fiscal outlook. On the negative is really we're looking at a probable increase in US 10-year bond rates. This year already up 70 to 80 basis points, and this is going to be a headwind for re-rating of SA bonds. I think you have to weigh this all up and come to a conclusion. I think despite these risks, the high spread where bond rates can move up 75 basis points and you still break even, points to being overweight bonds. And we've got 10% overweight relative to our benchmark. in the balance fund. The Rand, I think a lot of that confounds you, but I think if you follow the spread approach and use purchasing power parity as the key thing to target. So I've created a graph here. The blue line is the purchasing power parity, which creeps up over time due to inflation differentials. And the green line is the actual value of the Rand. Below that is a grayed out shaded line, and that is the deviation from fair value. And you can see over time, the Rand has tended back to fair value. So it's got very undervalued, for example, in 2000, 2001, snapped back to fair value in 2003, and actually was relatively overvalued for a period. If we look at more recent history, one can see in early 2016 was quite undervalued, snapped back to fair value, got undervalued during the COVID crisis, and has recouped most of those losses. So I think it's very important also to look at the fundamentals. Some fundamentals of South Africa, these are objective. I don't think a lot of analysts realize South Africa is a net credited nation. South Africa's net international investment position over 2 trillion positive. That's the source is the SARB quarterly bulletin. That was at the end of the third quarter last year. We've also got a positive carry, which means our interest rates are higher than US and Europe, and we've got strong trade surpluses. So I think using that approach, looking at the fundamentals and looking at these spreads, guides you when to move money offshore and can guide your asset allocation. A very, very powerful tool and has worked exceptionally well over numerous years. I think, now the question becomes, we've got these spreads, how do we use them? I think one has to also be cautious of taking binary positions. So being all offshore or all South Africa, even if you've got an edge, it doesn't make sense to put all your eggs in one basket. And we've created a hypothetical example to illustrate this. Let's take a coin toss with the following payout. Heads, you win 1.5. Tails, you lose. This is an even money wager. You can see the expected return on this would be 0.25% per bet. So you've got a positive expected return, but the question is, on repeated bets, how much of one's bankroll must one wager to maximize growth? And the analogy is really, even though we may have an edge with spreads, should we put should we go binary and put all the money in bonds or not in bonds? So it's really answering this question. So what we're looking here is the median outcome of a trial of 50 wagers and 10 trials. And if you put 10% of your bankroll in this wager, you'd make 3 times your money after 50 bets. If you put 50%, you'd actually lose on the median outcome would be that you're actually going backwards because you're over betting. If you put 30% of your wager on each outcome, you'll make 3 times your money. And after, the optimal outcome is putting 17% of your bankroll into per wager. That would optimize your median outcome, making 4 times your money on this. And really, there is a mathematical formula which solves this problem called the Kelly criteria. So the analogy is just to say, even though we may have an edge with spreads, we're not going to go all in or all out the equity market. We're going to take a measured approach, because even though our spreads are right on average, sometimes there are consequences that happen and one may be wrong. So we take a more measured approach. So how do we apply this to our funds? So for example, on the balance fund, we track these indicators. We've got further indicators. And if we're positive on equities, if our indicator says we should be positive, we'd go overweight equities up to 6%. On the flip side, we can go underweight equities. If we're negative on equities, underweight up to 12%. So you can see we're increasing weightings around 10% when we're bullish, decreasing weightings about 15% when bearish. I think we're taking a measured approach. We're not saying be totally out of equities or totally in equities. We're taking, this really ensures that we don't over or under risk the portfolio. I think it also gives you some protection if your judgment is wrong, that the portfolios can still deliver close to benchmark and you're still in the game, and we can still deliver the desired returns to clients. I think the flexible fund, we can be slightly more aggressive. So on the upside, we'll take 15% excess equity content and up to 20% less in a bearish scenario. How can this benefit you as a financial advisor? So what I've done is that since inception, I've taken a portfolio of the 7 largest balanced funds in South Africa. They've delivered a return of 7.5%. And then I've compared this to a portfolio which consists of the 4 largest balanced funds, and then also 20% in the central BCI balanced fund. And what you can see is by combining them, you've actually outperformed by about 0.8% per annum with only slight marginally higher risk. So you've actually managed to earn incremental returns for your clients without materially increasing risk. Just summing up, excuse me. I think the starting point of constructing a portfolio for clients is derive an efficient frontier, which really provides the discipline and the central point to invest optimally for the long term. Then by employing the right fundamental indicators, this can guide your strategic asset allocation to go over and underweight. I think on the flip side, let's say you're not going to employ this approach. I think it's very important to use the discipline of these indicators and not to be dictated by emotion and make the wrong decision. So on the flip side, don't be emotional and detract performance. For example, switching rands into dollars at 19 when one's feeling emotional. Rather steer clear from that. You may not bring money back, but rather just steer clear. I think one has to also be very cognizant of the investment fundamentals. For example, 2 years ago, property was flagging as very cheap, but this was really a trap. I think if one looked at the fundamentals, there was vast oversupply into a very slow economy, and one would have been cautious. Personally, we virtually had no property exposure, and it was really dictated by a fundamental view more than indicators. I think central refrains from all investment decisions as they are risky. So even if you do have an edge, you have to take a measured approach. I think our objective is not necessarily to be the top performer over a year, but really over 3, 5, and 10 years to be one of the leading performers. And that's why we take a more measured approach. I think strategic asset allocation is just one of the tools in Central's arsenal to deliver consistent top quartile performance. So there are numerous other techniques we have to look to deliver for our clients. And I think this really, I hope this has helped you, give you some ideas how you can improve your asset allocation and a disciplined process that will enable you to deliver the desired outcome for your clients. That concludes my presentation. Thank you very much for your time. Thank you.
Okay, Tony Bell, if you are ready.
Roger, if you can share.
There we go.
Thank you. Good afternoon, everyone. I'm just going to call up the presentation. Right. Afternoon, everyone. Thank you very much for your time. Thank you to BCI for the invite. We have the pleasure at Vunani of running a global equity fund. The topic today is how the world has impacted our sector decisions, and what the indications would be for sector and company choice for the next 3 to 5 years. It's a really meaty topic to cover in 10 minutes. And so the pathways that we've chosen for the presentation are 7 pathways that hopefully by the end of the 10-minute talk will marry what's happening in the global environment with what companies are doing on the ground. And I think the key takeout from the presentation is that it's not about picking a sector for the future, but really understanding how these pathways link, because there are many companies in good sectors that will do poorly, and there are good companies in bad sectors that will do equally well. So as a bit of a scene setter, I think the other presenters have focused very much on the inflation bogey and the rim. We tend to step back from that and say, well, that's currently the focus of the market. What's far more important is to understand the intersects of how growth will evolve. I think the chart that we see on the left-hand side shows that per the recent BCI report, growth is not exactly accelerating into 2022 and 2023. And so the headlines, we would suggest 6 months from now, are going to move away from the inflation focus to the growth focus. Unemployment rates coming down, but core inflation staying fairly constant. So our occupation at the moment is not focusing on the inflation story. The earnings numbers that carry this market through and the ability of companies to generate increasing returns on capital, we think is far more important, together with the structural shifts that are happening in the legislative environment and the fiscal environment from a tax perspective. This particular interesting chart from BCI has got a couple of takeouts. The first one that I always find quite amusing is that all analyst consensus forecasts seem to start off every year at about 10% in the bottom panel and then move upwards or downwards as the environment changes. So from that perspective, you can see that whilst 2020 was a significant decline, 2020 has been revised upwards, 2021, apologies. And the real takeout here is if you go back in time to when Trump came into power, seems like a long time ago, the market was very slow to respond to the impact of tax decreases. And we would suggest we need to be a little bit more careful about the impact of the Biden tax increases on 2022. That's just a sort of a bit of a scene setter. So pathway number 1 is more change. What I've done in each of the following 7 slides, and there are only another 7 in the pack, is I've listed the key drivers of the pathway, what the investment implications are, and then provided a graphic in the lower portion of the slide really just to illustrate it. I think the summary of pathway number 1, unprecedented liquidity, we're all well aware of that, biggest change since the Second World War, a massive change in all aspects of the global macro environment. Technologies come to the fore, and very importantly, a significant change, I would argue, in the convergence between monetary policy and fiscal policy. And so the implications from an asset allocation point of view, Roger's just been addressing that, and many of the excellent talks this morning have really spoken to the knock-on effect and the flow-through effect of how these changes have impacted markets, industries, the behavioral side, etc. I think from a stock picker's point of view, it's very difficult to tease out which of these themes to pick. We've got everything from AI, augmented reality, crowdsourcing, partnership models, health tech, fintech. And so the pathways that we've chosen to present to you today really look to try and distill all of this into a couple of factors that sort of filter the decision-making process. We're going into a world with more local online. The 2 panels on the left-hand side show you the pre-COVID forecast for e-commerce penetration. And then remember that world called globalization? It seems to have rapidly changed into regionalism. And certainly what you can see on the right-hand side, which is highlight number 1, if you like, is that the top companies in each of the sectors dominate margin. So the solid line is the margin earned by all companies in the sector. The dotted line is the margin takeout of the top 5 companies. Pricing power is everything. Pathway number 3 is more debt. This is the biggest stimulus package since the Second World War. It's going to influence economies. It's going to influence the value of the dollar. It's going to influence sectors, and companies are going to need to be able to adapt very rapidly to this massive change in spending patterns. When we look at inequality, I think a little bit of context is needed. We can see on the left-hand schematic that from 1971, the average income across regions has improved. But I think the main takeout from the research that we're doing on inequality at Vunani is really to look at the wealth effect. And you can see on the right-hand side that a significant amount of wealth in the poorer population is anchored in their homes, whereas in the top wealth bracket, the bulk of wealth is anchored in stock markets. And this influences how companies allocate capital and the extent to which industries themselves can change given the purchasing power of different population groups across different regions. So onto a world that we're all familiar with, more digital. I found the following schematic quite interesting, because what it does is it plots what the average company is doing on the gray dot versus what the top performing companies are doing on the blue dot. And effectively the schematic, in the interest of time, is separated into 3 segments. You can read it at your leisure. The top segment is companies are looking for better market intelligence. The second segment is really the allocation of internal resources. And the bottom section is really the redeployment of capital. And just to highlight a couple of things that I think are making a very big difference in sector and stock selection is how companies are reassessing their speed to market, how they're assessing the profile change of their customers, and how they're using technology to allocate and rapidly redeploy capital and skills within the business to become far more adaptive. And I think you can see that the difference between the gray dots and the blue dots are quite significant, and the difference between the two have compressed quite significantly from annual reviews to quarterly reviews. Pathway number 6 is more innovation. I think the key takeout of this is, as a company and within sectors, if you don't understand what your value proposition is, someone will define it for you. And so when we research companies in the global market space, we really want to understand what we call the 7 factors. We want to understand what industry the company is in, what X factor the company has, what's special. We want to look at the brand proposition. We want to have a look at the distribution architecture, the product, the people, the positioning. And then we want to combine all of that to understand what economic leverage the company might have and how that might influence the financial metrics. And then, Bruce, in the interest of time, the last slide. For folk who haven't read Jeremy Rifkin, Marginal Cost of Everything, I would highly recommend it. Companies in future are going to have to operate in a world where the marginal cost of everything rapidly reduces to 0. As you can see on the left-hand side, the cost of sustainable energy has come down to very, very low levels. And so ask yourself a question: how do companies and countries compete in a world where the capital investment is now being amortized? And for example, if you're operating largely off solar energy, once you've amortized the cost of that infrastructure, the marginal cost of your energy becomes virtually 0. That means your manufacturing has lower cost. It means your transportation has lower cost. and that's going to be a significant differentiator. So in a very short period of time, what we hope we've succeeded in doing is drawing together the need to analyze and understand the macro environment, what's happening with regard to change, how it's impacting industries, and the key takeout from our side is look carefully for companies that can survive in this rapidly changing world, because management teams are having to adapt like they've never had to adapt before. On that note, thank you. I will hand over back to Bruce.
Tony, thanks very much for that. If you could undo your screen share, thank you. Elodie Boyson saying, is the negative performance of the global macro fund over the last 12 months more of a function of a strong rand or a slow rotation from growth to value in the fund?
No, that's an easy question to answer. It's a big rotation from growth to value.
All right.
Underinvested
that's
in financials.
A good answer. And then a question on the currency. Prediction on the rand for the next 12 months?
Pick a participant, Bruce. I haven't got a clue.
The question's to you. So is it a good time to take rands offshore at 14? Okay.
Yeah, I would answer the question slightly differently. I don't think it's about the rand. I think it's about where you can find a diversification of growth vectors. South African equity market is very skewed towards mining stocks, certain financial retail. In the global marketplace, there's a significant exposure to growth companies or value companies, depending on your preference, that you simply can't find exposure to locally. And I think it's that context that one would need to answer the question.
Okay, now thank you for that. Elodie, thank you very much for your questions. Gentlemen, thank you. Questions for these guys, please, in the chat room afterwards. Let's get to the meeting room afterwards, just to ensure that we get our timekeeping correct here. As we hand over to Ashraf Haq now from Sands Capital, looking at, you're really just introducing emerging markets, Ashraf, and it's good to have you with us this afternoon. Take us up to the breakaways, please.
Excellent. Let me share my screen here and I will get going. First of all, thank you for having me. Can you see my screen okay?
Yes, we can.
Perfect. Again, as mentioned, my name is Ashraf Haq. I'm a senior portfolio manager with Sands Capital based in Washington, D.C., where I co-manage our emerging market strategy, our international growth, which is an ACWI ex-US strategy, as well as a global Sharia portfolio. And today I'll be sharing with you our perspectives on where some of the most exciting opportunities are in emerging markets, and also share a few case studies with you. There's a disclosure statement which my legal and compliance want me to put up, and if you want copies of that, I'm happy to share those with you later. A little bit about Sands. We were founded about 30 years ago. We invest in some of the world's leading growth businesses in public and private markets. Examples of businesses we own are Sea Limited, Visa, Amazon, Netflix, a lot of the businesses that my prior colleague was just speaking about, the growth, innovation, technology-led businesses. And we tend to be large, long-term owners. In South Africa, we've been invested for about a decade. Recently, we have gone to zero in South Africa, but we used to own Naspers for many, many years. And today in our emerging and international fund, we own Prosus, which is the Naspers subsidiary. Happy to answer questions specific to South Africa later. With that, let's get to the topic at hand, which is the shifting landscape of EM investing. The EM asset class is only about 35 years old. And those of you in South Africa have lived through most of this. But one way to look at it is that's gone through three distinct periods, and now we're entering a fourth phase. Just to quickly recap, one way to look at it is it started with top-down macro investing. Let's figure out the best country to be in and maybe buy the biggest telco or energy exporters. This was the rise of the Asian tigers in Mexico, and it ended with the Asian financial crisis. The second wave was as China joined the World Trade Organization. It supplied cheap exports to the rest of the world, and it fueled a commodity super cycle. This was a great time for Brazil's and South Africa's and countries like that. And the index peaked in about 2007 and ended with the great financial crisis. And we've yet to recover that level in US dollar terms. And the third wave, which is when Sam started doing EM investing, was with capturing the rise of the middle class, the BRICS and consumer convergence. We started looking for business models that had worked in the developed world, because it turns out that as folks get to the middle class, they tend to do the same type of things. It also led to the rise of the internet giants like Tencent. And at the end of the decade, we saw mega cap market caps like Tencent, Baba, TSMC. And as you can see from the logos we're showing here, those are the businesses that were the biggest market caps during the middle of those each of those waves. You can see the composition, the type of business has changed dramatically, from telcos in the first wave to a business like Luke Oil to now the top of the EM. The biggest companies in EM are now these tech innovation-led businesses. So what's next? Well, over the last 3-4 years, we've seen a different wave of wealth and growth, wealth creation and growth. Those of you who remember the early days of the US internet may recognize this logo, which we've modified a little bit. This is the America Online logo. We're calling this period, just for the purpose of this presentation, EM Online, or EM 4.0. In short, what we're seeing is that technological innovation, which over the last decade was mostly in Silicon Valley or parts of Europe, or other centers of innovation, is now diffusing through the EM world as globalization, seamless communication, and low cost of building and scaling businesses are unleashing a wave of innovation that's going from China to Latin America and everywhere in between. Moreover, in many of these countries, the legacy competition and behaviors can't compete. So we see a leapfrog effect that we don't really see in many of the developed worlds. So let's dive into these ideas a little deeper. It all starts with people getting online, and it's happening rapidly. Depending on which country we look at, anywhere from 50 to 70% of the EM population is online. We double clicked on Southeast Asia as a very exciting region. In Southeast Asia from 2015 to 2019, we saw about 100 million people go online, and just in 2020, another 40 million people went online. And we've been studying this, investing in this idea for almost 2 decades now. It turns out people want to do the same things when they go online. They want to shop, search, find friends, play games. And then as they get more sophisticated, they start ordering rides or Ubers, ordering food delivery, buying financial services. And then finally, eventually, like what we're seeing in the developed world now, buying used autos online, large purchases, large ticket items, homes. In the US, we own Zillow in one of our portfolios because our view is that homes are going online in a big way. Prescription drugs, this is a new category that's going online in many countries. So the demand side is there. And the supply side is also catching up. We're seeing technology creating a ton of opportunity, not only in the obvious places like e-commerce and search, but also in many non-obvious sectors like lending and healthcare, real estate. And the supply barriers for businesses are coming down in many countries. The cost of computing power has declined dramatically because of cloud-based computing. Social media networks allow businesses to acquire customers much easier. And third-party e-commerce platforms allow businesses to reach those customers with their physical goods. And we have investments on the right-hand side. You see some of the businesses we own in our portfolio that are tied to these ideas. In many of these business spaces, in e-commerce, we own businesses like Baba and Mercado Libre and C Limited. In search and social media, we own businesses in China and Russia. Fintech, Brazil, for example, is a place where banks have been very dominant, and there's been an oligopoly of the leading banks. But there's a lot of fintech innovators that are disrupting that space right now, and we own a few businesses there. When the demand and supply match up, that's when we find the mega cap elephants that we've been hunting for. What this slide tries to show is that as different ecosystems hit a critical mass, that's when we see these giants forming. So for example, the US hit 50 million internet users in the late 90s and created Amazon, Google, Facebook, etc. In China, the same phenomena happened in the early 2000s, and that's when we saw the rise of Baba, Tencent, and businesses like that. And over the last 5 to 7 years, we've seen each successive country or region in India, ASEAN, Latin America hit this 50 million threshold, in parts of Africa as well, although we don't own much there because of liquidity. But it's created a host of investment opportunities of what we believe will be the next mega caps. These are going to be the defining companies of EM 4.0. And to get to these, I think we need to lean on our global experience and business model expertise. The early days of EM investing in tech were all about China, but the story is broadening out pretty dramatically. What we're showing here is that since 2014, more than 10,000 businesses of this sort have been formed in the emerging markets. About half of them have been outside of China. So it's going from a pretty narrow US and China mega cap tech story to a much broader story across many of the emerging markets. And it's resulting in big changes to the index. What we're showing here is that old EM, which is energy, industrials, mining, utilities, which is the dark blue line, it has been declining as a percentage of the benchmark, whereas the newer innovation-fueled parts of EM have been growing pretty dramatically. Still, the nature of the businesses are changing, and having that global perspective, deep understanding of tech innovation and disruption is key. A couple of observations on a benchmark. Some of the biggest winners in EM, like C Limited and Mercado Libre, are still not in the benchmark for various construction reasons. And I think that having this global perspective is really helpful, because a lot of locals, for example, don't really have the ability to evaluate these businesses effectively. Let me give you the example of Mercado Libre, for example, which we've owned since it was $1 billion market cap, and today it's $65 billion. And it's been expensive. I've been following that company for over a decade, and local analysts have thought that was expensive ever since it was $1 billion company. The same story with C Limited. We also benefit from investing in private markets, which enables us to identify some of these up and coming winners sooner. Let's talk about, as I wrap up in my last 5 minutes, let's talk about a couple of the different examples of innovation we've seen. And this is not a mutually exclusive or completely exhaustive list of ideas, but there's 3 models of innovation, or three patterns broadly that we've seen across emerging markets of how businesses are innovating. And I'll share an example from each one. The first bucket is copy, adapt, and localize, which is look at what's happening in the developed world or in other countries that are ahead of the curve and adapt to your country. So for example, Tencent Music is a business we own in China, which is looking at global music streaming leaders like Spotify and Amazon Music and Apple Music, and building a local Chinese solution for local Chinese characteristics. The example we're showing here is a business called C Limited, which is in Southeast Asia. Started off by literally adapting games from from EA Sports and Tencent to an ASEAN audience. So if someone in Thailand is playing FIFA soccer, they need to be able to access Thai national team and Thai lingo, and Garena did that, and that's how they built their business. Before they launched a very successful self-published game called Free Fire, which is very popular in many of the emerging markets. And the adaptation that they did there was a very low bandwidth solution that works in many countries with limited connectivity. They then went to e-commerce and built the leading e-commerce company in Southeast Asia, not by being the first mover, but by going mobile first, being the right categories, and looking at what Mercado Libre and Alibaba had done, and offering zero commission sales to sellers to create an ecosystem. That was very controversial because there was it wasn't clear that they could be profitable. But now that they've built that network effect, that scale, they're able to charge, they just reported earlier last week, a 6% take rate from zero just only a few years back. And soon they're going to go into digital finance, and we believe they can be very successful there as well. The second pattern or innovation model we've seen is what we're calling innovating in really boring areas. And money lending is one of the oldest businesses and quite boring if you ask me. But we own a business in India called Bajaj Finance, which is doing some really cool things here. So imagine walking into a store to buy a cell phone or a laundry machine or air conditioner and scanning your thumbprint and getting approved for a loan within a minute or two. That's what's happening in India today for Bajaj Finance customers. Bajaj is in the business of making consumer loans, and they acquire customers by providing them consumer durables financing and then eventually giving them auto and home loans. And they've built a really innovative solution on what's called the India Stack, which is a technology platform that the government of India has developed that allows companies and consumers to communicate with biometric data, unified payments linking to bank accounts, a consent layer, which allows data to move around, and digital records. And then I mentioned the leapfrog effect happening, and I want to close here with the China payments example. One of the things that we've noticed, for me, I live in the United States. When I need to buy something, my credit card works 99.9% of the places. But when I travel to the emerging markets, many of these countries, it's cash, and credit cards is not as effective. So many of these countries, with Safaricom in Africa being the best example, have moved and skipped credit cards altogether to digital and other forms of payment. China's the banner child for this. If you see these dark blue circles, you see the mobile payment adoption in China. It dwarfs what's happening in the United States because the consumers there went straight from cash to QR code-based payments and skipped a whole process generation. We see example after example of that in Latin America, ASEAN. We own a business in Kazakhstan today that's doing the same thing. So let me conclude there with where I started. Just to summarize, we believe that we're at a really important transition point in emerging markets where tech-driven innovation is changing the landscape rapidly. And it's going to broaden the story from just China tech to a much broader EM story that we believe will create massive wealth in India, Latin, Central Asia, Africa. And we believe that success requires an intense focus on innovation, disruption, pattern recognition, and access to businesses early in the private markets. I have to say that we're more optimistic today about the emerging markets than we have been at any point. And with that, I'll pause, and I'm happy to take any questions from the audience.
Ashraf, thank you. Let's get rid of your screen if we can. And yeah, just your aversion to South Africa as part of an EM environment. I think that might be a question that is forefront of people's minds.
Yeah, it's not a macro call, Bruce, but it's really, I think my prior speaker touched on this, which he talked about the nature of the businesses in South Africa. We tend to do a lot in technology, healthcare, consumer. And in the past in South Africa, we've owned Naspers and ShopRite, but when we compare it to the global opportunity set, we just don't see we don't see enough businesses that we think rise to the top 30, 35. That's all we're owning really in our portfolio. We hope that changes over time, but we just is not there today.
So do we. The favoring process of a Naspers. Naspers came out with an incomprehensible statement, which they've then had to explain and re-explain and re-explain again. In terms of taking Naspers assets, putting them into process, trying to narrow the discount with Naspers and, of course, Tencent in China. You're a fan of process. Explain.
Yeah, so we've owned both Naspers and Tencent for about a decade now, and we continue to own process in Tencent today across several of our strategies. Tencent itself is, Naspers had a problem where they made the most successful investment probably in the history of mankind, and just got stuck with this massive asset that they're trying to unlock. And I have many friends in many different contexts who've tried to play the stub trade, and it's just been a very difficult situation for them. Process was an attempt to unlock that value. We do think that the non-Tencent businesses and process are attractive. For example, Naspers has built the leading classifieds business in emerging markets, which is a really good asset. Where I live in the United States, classifieds is a terrible business because Craigslist, it made it a free, non-innovation led businesses. But even Naspers is making a big play here with OfferUp and Letgo. Then their investments in fintech, in education, and food delivery are all very attractive. So as we evaluate process and the non-Tencent parts of the business, we do think that alone is one of the top 30, 40 businesses out there. I think, of course, the profitability has been masked by the size of the Tencent investment, also the losses that come with these type of business models. But I think those should resolve over time. And so that's the hope we have by being owners of Prosus.
Ashraf, thank you very much. You'll go into your breakaway room now, and I'm sure many people will follow you there. If you go on to the chat box at the bottom of your screen, the entire chat will open up, and there are all of today's presenters in different rooms. Pop into the rooms and go and see them. If you want to pop out, that is possible as well, but for stability's sake, I think it's better if you choose your room and go into it, and there you can interact in greater detail with each of the presenters, particularly the guys toward the end of the day who have not had the benefit of time to answer your questions as those have come through. So can I suggest now, please, you make your way to those chat rooms and enjoy your discussions for the next 45 minutes or so.
Thank you, everybody.